This is an unfamiliar political situation in just so many respects.
It's very difficult to look at the data without having the data.
The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
Earnings season is going to take on even more importance if we have a lack of government data.
Companies are going to operate through fog.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Payrolls Friday without the payrolls. Division in Washington leading to a delay in the monthly jobs report as the government shutdown enters day 3 with little sign of ending. Investors are looking through the noise, sending equities back to record highs. The S&P on a 5-day winning streak.
And the jobs report today is MIA. So basically, we need to wait until the government reopens. And Jonathan, right now, what's happening in Washington, D.C., even though they're going to put the clean resolution back on the Senate floor this morning for a 4th time at some point today, it's not going to pass. So lawmakers go home for the weekend, and we do this all again on Monday, which means we are going to get a delayed jobs report. And what is starting to get people a little bit more nervous is not so much this report, but if this goes on for another week or two, what does that mean for the October print we're supposed to get in November?
We've seen this movie before. We just haven't watched this movie for quite a while. You've got to go back to 2013, 16-day delay. Ultimately, a 2-week delay to the jobs report, 16-day shutdown. This feels different, though. It feels like the Federal Reserve is at some kind of inflection point, trying to decide whether this slowdown in the jobs market is the real deal. And that Federal Reserve decision is only a little more than 3 weeks away.
Yep, the Federal Reserve decision at the end of the month, October 28th and 29th, and then we're supposed to get CPI on October 15th, and obviously we would have had jobs today. So there's potential that the Fed is going into the next meeting blind when it comes to the official government data, and they're going to have to work off things like ADP and what other people would call second-tier data. But we already know at this moment they have a bias, as you've said a lot of times, given what Jay Powell has said and what they did at the last month's meeting, they have a bias to this weakening labor market.
The senator from Massachusetts had things to say to CNN, saying this: let's be clear, the jobs data scheduled to come out this Friday has undoubtedly been collected and the president must release it. Do we know that for a fact?
That he must release it? We don't know that for a fact because BLS already told us what their plans are, which is they will cease all economic data given the shutdown. The president, though, could essentially deem some people at BLS essential, and they can go in, put the internet on, as Henrietta Trey says, and push the button and release the jobs report. That's not happening right now. I do have an ask into the White House to know whether or not the standard operating procedure of Thursday evening, the NEC director would get the jobs report and brief the president on it. Did that happen or not? That is going to be a question because a lot of people are going to start really paying attention to Trump's truths today if they think that that happened.
There's a different kind of feel to the first Friday of this month. Equity futures on the S&P up by 0.3. Following a 5-day winning streak, it could become day 6. Chris Ferro of Strategas joins us in just a moment with stocks at all-time highs. Dan Ives of Wedbush on the room to run for the AI rally, and Sarah House of Wells Fargo on gauging the economy without a payrolls print. We begin this hour with stocks on their longest winning streak since July. Chris Ferro of Strategas, a Baird company, staying bullish, writing the fourth quarter is one of the few examples in our work without any significant autocorrelation. It just tends to be good from about mid-October forward. Chris joins us now for more. Chris, good morning.
Good morning.
Any reason it's different this time?
I don't think so. Of course, kind of we'll evaluate as the facts come in here. But one of the unique things about 4Q is what preceded it almost has no bearing on what happens. Whether the first 9 months of the year were weak or whether they were strong, 4Q, just as we write here, tends to be pretty good. What I think is more important, though, is we enter this period with trends generally pretty good. About 65% of the S&P is above the 200-day moving average. That's pretty good under the surface. Leadership has generally been pro-cyclical. So, as we've worked our way through summer and through September, I don't see much of a change to the leadership fabric of the market that would get us particularly worried about what's in front of us here into the final few months of the year.
There was a great phrase in your recent research: attitude follows price. Attitude follows price. What did you mean by that?
One of the undefeated rules of Wall Street is what you think is merely a function of what has happened, right? Flows follow performance, not the other way around. And what we were really talking about is how the tone on China has begun to change here. Not because there's been any grand change to the macro, but because the stock prices have gone up. We've been very bullish China for 2 years. We thought ultimately this would happen, where the prices would ultimately force investors to capitulate to the tape, right? The market goes up long enough. I think the Hang Seng's up 90% over the last 2 years. There comes a point where you can no longer use the, quote, uninvestable moniker that became so popular. So we think it's part of this sentiment process where attitudes are ultimately shaped by the price action.
What tone on China are you talking about? How investors feel about it or the policy discussions?
I think how investors for the, how many years now the term was uninvestable. I think anytime you hear that phrase, your antenna should go up and start doing some work. And that was our approach 2 years ago there. We began to see all the momentum signals that we generally see at the start of a big turn. And, here we are today. Chinese financials act pretty well. Chinese discretionary acts very well. I think, interestingly, Chinese materials have started to turn up here. We've seen copper break out. We've seen some of the Euro basic resources turn. And, don't discount the fact that Nike turning up here, LVMH turning up here. I think all those are part of this positive China tone.
So you think China is actually changing within?
I think the market wants to go up as it has. I'll leave the longer fundamental call up to someone.
Well, if LVMH is doing well, maybe consumers are going out and spending more.
I think the tone on China was so negative for so many years that even incremental improvement is being reflected in European luxury names, in U.S. apparel, in global basic resource stocks. I think we're still relatively early in that shift. And watch this copper here. London copper through 10,000 is a really big breakout.
This raises questions about where leadership's going to come from. Yeah. If you're looking for a cyclical upturn abroad, do you want to play it through various proxies? Or do you just want to stay at home and play the AI theme in America? Lots of questions about leadership this year. The leadership has come from abroad. You've seen the outperformance there, but the bulk of it came in the first quarter. Mike Pyle of BlackRock talked about this recently, and he said that since the middle of April, you've seen US leadership basically get back in a driving seat led by AI, which is kind of odd that was a few days after April 2nd. How are you thinking about leadership and where it comes from now?
Well, let's make a couple observations here. The main European indices peaked in March. And then they consolidated all spring, all summer, and then this week they broke out again, right? So this 5-6 month pause resolved higher. You saw new highs in Euro stocks. CAC is right there. DAX is doing it as well on the back of Rheinmetall and Siemens Energy and all those big, defense or energy names. When you look globally, Kospi strong, Japan strong, China strong. So I don't really have a lot of sympathy for the idea that this is 10 stocks in the U.S. leading this whole thing. This has been very, very well participated when you look around the world. When you take the domestic picture here, yes, the leadership has come from a select group of AI or AI adjacent type names, but the equal weight S&P is also at new highs here. Russell 2000 made a new high a week ago. So again, I don't have a lot of sympathy for all the breath bears out there. This has been broader than I think people have given it credit for.
When you say Kospi in Korea, I think of international trade. When I'm looking at the move in copper, gold as well, I'm not thinking disinflation, quite the opposite. That's where there's some tension at the moment. Got a Federal Reserve very preoccupied with a downturn in the cycle and downside risk to employment. And when you look through the market and what it's telling you right now, it's offering a very different picture about the future. How do we resolve that tension in the months to come?
Well, I think it's funny that we're all alarmed that the Fed is blind without the payroll data. They're not particularly good when they have the data, so I'm not convinced it's that big of a deal. I've been of the view that the Fed is likely cutting into a reacceleration here. I think that's been the message of the market. I think that's been the message of the cyclicals. I do think, John, there's probably some level on yields down where I would have to question that, right? If we're sitting here and 10-year yields are sub 375 or some number, I think they bottomed about 384 on April 4th, 5th, 6th. Anything under that, you begin to wonder, is the market actually sending a different message about the trajectory of growth here? But I generally think we're okay. When I look at the messages globally, it seems more consistent with growth repicking up than deteriorating from here.
So even though we know the bias is to cut, you don't think they actually should?
No, I want to be clear on one thing. It's funny, we always joke in our work, what is the value of the Fed or Fed speakers when you have the 2-year yield? And the 2-year yield at 350 today would say we need 3 cuts to get back to neutral. I don't think bringing Fed funds from 4.25 to 350 is some big overt easing. I think it's a recognition that the policy rate and the market rate are pretty divorced here, and we ought to get those back in line before we do have a problem down the line.
So you're on Governor Myron's team?
I think the 0% neutral rate's a bit aggressive. I think when you look at where the market is set, somewhere between 3 to 3.5, I think, is an appropriate, quote, neutral rate.
That sounds like Team Besson, that you believe the inversion of the very front end of the curve does offer a signal. And that should drive the Fed.
Yeah, and our whole approach this year, we've kind of revised Marty's why, don't fight the Fed to don't fight the Treasury. And I think the market's been pretty clear in listening to that message as well.
Your point in the jobs market is a point well taken, even when we have the payrolls report. Look how much it's been revised over the last 12 months. Look how much it's caught this Federal Reserve offside. Just in the last 2-3 months, Chairman Powell has had to flip from one story to another.
It almost feels like the payrolls report was already canceled in the figurative form by the president, and now it's literally being canceled because of the government shutdown, and that is why the market is looking through it. But there will become a problem if this shutdown prolongs, and then you have an issue with data collection going forward, and it's going to put the BLS behind by a number of weeks.
Chris, one final point, please. Let's wrap it all up. Conviction trade right now. What do you really, really like? What are you super comfortable with that you're still maybe getting a bit of pushback from clients, which maybe makes you more confident about where this is going?
Yeah, I'm really leaning into copper here. I think something has changed in base metals over the last number of weeks. I know you could point to the Freeport mine closure in Indonesia, but a lot of this improvement predates that. So something's happening there. I think it demands our attention.
Chris, it's got our attention. After speaking to you. Thank you, sir. Appreciate it. Thank you. Chris Ferro there of Strategas. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. Well, we're in the third day of a government shutdown. The Senate is expected to hold another vote today on a stopgap spending bill to reopen the government into mid-November. Democrats are holding firm on demands to extend healthcare subsidies. President Trump is threatening to slash jobs at what he calls Democrat agencies that don't align with his agenda. Applied Materials trading lower in the pre-market. The largest U.S. maker of machinery used to manufacture semiconductors says an expansion of rules that restrict the export of its products to China will take another chunk out of its revenue. The company expects it will have $600 million in lost revenue in fiscal 2026, which runs through next October. A large fire has broken out at a Chevron refinery in Los Angeles County. Firefighters responded after multiple reports of an explosion at the El Segundo operation, south of the Los Angeles airport. According to the company's website, the refinery, built in 1911, supplies 20% of all motor vehicle fuels and 40% of the jet fuel consumed in Southern California. That is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. An unimpressed AMH. Where's the Yankees wrap?
Yeah.
Where's the story? Where's the sports update?
Team. I walked in today with all my Yankees gear, and I said, make sure it's in every brief. I think, we have some haters in the control room. That's what this comes down to.
I didn't know that.
We do.
Okay. Who do they support?
Actually, a lot. They know who they support.
Okay.
Why do you think Lisa's off today?
Oh, right. This is like a day of rest after what happened with the baseball.
Yeah.
Wasn't aware of that. Haters in the control room. Brutal. Up next on the programme, a data delay.
Probably this report is not coming out. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
We'll get into that in just a moment. Ed Mills of Raymond James joins us next, live from New York City this morning. Good morning. It is Payrolls Friday without the payrolls. If you want the estimates anyway, the median in our survey was 53k. The range was pretty wide. This is a guessing game. The low was -20, the high was 109. The 3-month average, huge step down from the start of the year when we were looking at 200k. The 3-month average now around 29,000. The equity market doesn't really care. It's higher by 0.3% on the S&P, following a 5-day winning streak, the longest since late July. Can we make it day 6? On the Nasdaq, higher by 0.3%. The S&P, the Nasdaq, the Russell, all up on the week. 2-year bond yields down on the week. Check out this in the bond market. 2-year at the moment, trading at around 355. Yields higher on the session by around a basis point on 10s, up by not even a basis point, around 4.1%. The data so far this week has not been great. Weaker than expected data across the board. The ADP, the worst since 23. ISM manufacturing soft. The quits rate, I think the lows of the year. Consumer confidence, 5-month low. It's not been a great picture, even without the payrolls report. That picture's not been fantastic.
The picture hasn't been fantastic, which is why the market is basically saying the Fed already knew that the data was coming in weaker than expected, especially off of the numerous labor reports we had over the summer, which is why they're looking through this and saying, does the Fed actually need the jobs data in order to continue on this cutting cycle by the end of the month? And then you brought up a great point, Jonathan. Before the data was literally canceled today because of the government shutdown, it was figuratively canceled by this administration that cast a ton of doubt on it. And then the market has been talking about the fact that they do want crisper, more accurate data, and they want a revised BLS to take this on hand to try to get more up-to-speed data, and then you don't see all these revisions.
It's the main focus for us this morning. Under surveillance this morning, a data delay.
Probably this report is not coming out, and it's certainly why we think the BLS said that all data collection will cease. The less data that come out, the less of a reason the Fed would have to deviate from the dot plot, meaning the more likely it is that they will cut exactly 25 basis points in October. Hard to really say that they won't go ahead and carry out what they had signaled in mid-September under that situation.
So here's the latest this morning. The release of key economic data in jeopardy as the US government shutdown drags into its third day. Bloomberg's Mike McKee tracking the story closely. He joins us now. Good morning, Mike.
Good morning, John. I think the market is telling us that if we could only have Payrolls Friday, if we could only have one of those things, we'd rather have Friday than payrolls. But it looks like we're going to have to wait a while to get payrolls anyway. And the big question as we go forward now is, are we going to get the CPI on October 15th? Because that's going to be key to the Fed. We have seen some evidence of strength in the economy in terms of retail sales and overall spending. And if the inflation rate is not going down, or if it should tick up, then it makes it harder for the Fed to at least do anything in December. They might, as Annmarie was saying, go ahead and cut in October because the Fed said they would. But at this point, we don't know where we are, flying blind in a cloud, as was said. So we're relying on alternate data. The alternate data don't look as bad, except for ADP, as people think. The Revilio people who have this new report out say we got 60,000 jobs during the month. The Chicago Fed estimates unemployment at 4.3%. The Atlanta Fed wages at 4.1% year over year. So that would be considered we don't really need to think about cutting rates report if that's what we got. We just have to wait and see if we can get it. And the other big thing that we have to watch for is if this is not settled by 3 weeks into the month, then the unemployment report and the CPI report for October are threatened because they won't be able to collect the data.
There are consequences. Mike McKee, thank you, sir. Stay close. Mike McKee's going to be a key feature of this program this morning, walking you through where to look and get additional data to get a read on what's happening in this economy. Ed Mills of Raymond James joins us now for more. Ed, we're in day 3, probably going to go into day 4, 5, 6. I just wonder how long do you think this is going to go on for?
Yeah, John, I think most people here in D.C. put the over-under about 2 weeks in, kind of miss a first paycheck and pressure builds. The outer bound, people are willing to say, is once we get towards the end of the month when rent and mortgages and kind of all the bills are due. But the traditional playbook is not kind of assigned to this shutdown. So really the kind of honest answer is no one knows exactly how long this is going to last. There is an off-ramp to kind of reopen this government. It is a CR to open the government, but is negotiations enough, or do Democrats actually need a deal to reopen this government on the ACA subsidies and other healthcare programs? That's the big question for me.
Ed, this might be a bit granular, but do you think the BLS gave the NEC the jobs report last night as they normally do, standard operating procedure, and that the president actually knows what the report is?
Yeah, Annmarie, I got a lot of questions about that at Raymond James, because one of the conspiracy theories out there was if this jobs data was not very good, why release it? And if it was actually good, would President Trump say, hey, maybe we should kind of get this out? You do have to remember that there are a lot of federal employees that were set to lose their jobs on October 1st, regardless of the government shutdown, those who took out the early out, the Musk out. And so to the extent that this might be a weaker jobs report than what they'd like to show, certainly convenient not to have this released this Jobs Friday.
Well, we'll be paying close attention to any truths he has today regarding the non-report we're not expecting anymore. The White House yesterday...
We've gotten that in the past.
Yeah, the White House yesterday, the president was talking about how he had this meeting with Russ Vought. What's come of it? Are they going to make these layoffs permanent?
I think they're going to attempt to do that, Annmarie. I think that this is kind of the playbook that I've seen from President Trump time and time again. President Trump doesn't spend a lot of time on the defensive. He always wants to go on the offensive. He wants to kind of increase the heat, increase the pressure, increase the cost on congressional Democrats for them not providing the votes to pass that clean CR. I do think that actually might extend out the overall government shutdown, because I think once you start permanently attempting to fire people, Democrats put that on their kind of number one list in terms of what it takes to turn this government back on. This is certainly something that the administration has wanted to do. So far, the unions are standing with Democrats and saying this is just kind of an inevitable step. And so if we can pull this forward and maybe get a protection in a restarting of this government, they're open to that. But yeah, they're absolutely moving forward with these firings, and they're going to see how far the courts allow them to go.
Where are the firings going to come from?
Well, at first, it seems like from independent agencies, but I think it is going to be the agencies that Project 2025 identified. They are saying that if you do not have a explicit appropriation, then that is going to be the reason why the president has discretion not to keep that. So looking at kind of Department of Energy, looking at Department of Education, disfavored agencies out there are probably going to see the proportionate number. And then this fight about independent agencies, what is their constitutional role? Because they're in this kind of quasi executive branch, non-executive branch role. They certainly sought to exert more power over there by firing a number of heads of executive agencies that were appointed by President Biden, approved by the Senate, but were not the preferred pick anymore of President Trump. So that push of executive power is going to be once again tested.
Just 3 days in, who at the moment do you see the public blaming for the shutdown?
Yeah, so Annmarie, all of the polls show so far Republicans getting a disproportionate amount of the blame. One thing that we're looking at is a lot of the polling says, do you blame Democrats or President Trump and congressional Republicans? Is it the kind of fact that they add President Trump to this that is skewing this? But it is really important. I'm glad you asked about polling, because it is probably polling that will determine who kind of blinks first. Back in 2018, there were polls out that showed 90% of the American people were blaming Republicans. That turned the government back on. If Democrats continue to get an advantage in polling, they are going to continue to push. If that switches around, that's where the pressure builds. That's where they think that they might have to capitulate. And they will also be looking at these November elections, gubernatorial statewide elections in New Jersey, Virginia, elsewhere, as a kind of warning sign. If they are getting blamed, those are kind of gubernatorial seats they absolutely want to keep and pick up. If they feel as if that's at risk, I think that also potentially changes the calculus.
Ed, as you know well, we all know, unlike us, people have lives. I wonder how many people are actually even aware the government's shut down. When do they start to realize that? When does it get real for the country?
Yeah, so we have seen it get real for the country when TSA agents who are kind of government employees stop showing up to work or kind of call in sick because they're not getting paid. If airport lines kind of get longer, people get frustrated, but that's still just a segment of the population. I think that they will see stories about military personnel not getting their paycheck. They put their lives on the line for the country. If they're not able to pay their rent, if they're not able to pay their mortgage, if they're not able to kind of put food on the table, those type of stories kind of break through. But the reality is in a partial government shutdown, essential employees still go to work. And so the essential services of the U.S. government continue to work. So for the vast majority of Americans, a government shutdown is just a headline coming out of D.C.
Ed, thank you, sir. Appreciate the perspective. Ed Mills there of Raymond James. You talked about the significance of the airports. Also, just the idea of standing behind something that means that military personnel aren't being paid. That should make everyone uncomfortable in Washington.
Yeah, and the next pay date for them is October 15th. And certainly they're going to hear from their constituents and military personnel, people that say, no, wrap this up. These people need to get paid.
If you are just joining us, welcome to the program. Equity futures this morning, positive by 0.3. Coming up, we'll catch up with Dan Ives of Wedbush as Tesla posts record quarterly sales. 5-day winning run on the S&P 500, up every single day this week and some. The longest winning run going back to late July. We had some weight to the rally this morning, up by 0.25% on the S&P. On the Nasdaq 100, higher by 0.3. On the week so far, we're positive on the S&P, the Nasdaq and the Russell too. In the bond market, 2-year bond yields lower on the week by around 10 basis points, up this morning by a single basis point. We're back up to, let's call it 355. The data we have seen so far this week has been weaker than expected, particularly from ADP, and ISM manufacturing wasn't tremendous. Later on this morning, we will get some data. Won't be payrolls in 2 hours' time. We're not expecting that, but we are expecting ISM services. That's a key data point going into the weekend. Going into the weekend, let's sit on this. Switch up the board. Gold. Gold is up for the 7th consecutive week, the longest run since February. It's higher again this morning by 0.2%. All these estimates, 4K sounded mental 12 months ago. We're very close to 4K already.
Yeah, and the next estimate, of course, is going to be 5K. I think giving gold a little bit of extra oomph this week is, of course, the government shutdown. But what we've seen from gold consistently more than 40% this year is the fact that risk on, buy gold. Risk off, buy gold. It is this perfect hedge in this environment. And there's a lot of geopolitical factors as well that is shaping into why gold is perfect right now for this environment, because central banks are buying it.
This morning, we're buying gold 38.63, very close to 38.64. 3 hours away from the opening bell. Some single names for you. Some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. This morning, we are not buying Applied Materials. Shares are down this morning after filing from the company yesterday. It makes equipment that makes chips and says that the U.S. Commerce Department has expanded their restrictions of what can be sold to China. They said the hit for them for fiscal 2026, which runs through next October, would be $600 million. So shares down 2.5%. Elsewhere, Rumble, this is an online video sharing platform, signed a deal with the AI company Perplexity. They say that this is going to help basically serve better videos to its users and at the same time help content creators reach exactly the audience that they wanted. So you sign an AI pact or you just talk about AI in this environment, and there you go. Shares are up 14%. Also looking at a rebound in Tesla shares this morning. They fell 5% yesterday. We haven't quite made that up, but they fell 5% after record orders, record new vehicle sales for them. But it was a sugar rush. At least that was the consensus, that there had been that expiring $7,500 tax credit for EVs. So consumers rushed in to buy before that. So shares fell, but they're up about 1.33% this morning, John.
Danny, thank you. More from Danny in the next hour. We'll catch up with Dan out of Wedbush as well in a few minutes' time. Let's get you up to speed on some of our top stories. On our radar this morning, the crucial September payrolls report expected to be delayed by the ongoing government shutdown. Gridlock on Capitol Hill threatening collection of data for future reports, including CPI and PPI, due later this month. Elsewhere, the president, Donald Trump, weighing on aid package for U.S. farmers of up to $14 billion. The Wall Street Journal reporting the money is expected to come from tariff revenue as Trump plans to urge Chinese leader Xi Jinping to increase purchases of U.S. soybeans. And finally, research firm Tech Insights finding Huawei's advanced Ascend AI chips are still relying on foreign tech. Despite China's push for domestic production, components from giants like TSMC and Samsung were found in multiple samples of Huawei's chips.
I think there's 2 points to take from this. One is that China is still reliant on U.S. technology, foreign firms' technology. They are not doing this all homegrown as they want to do. Second point, Huawei has been on the entity list since Trump's first administration. So some of this tech should it be getting to Huawei, is potentially getting to Huawei. And I think this is going to be a big concern for Washington, especially as they're in the middle of these trade negotiations with China, and maybe it's another chip they can play.
So positions, leveraging. This is how we're positioning going into these talks. You've got the Chinese ultimately dependent on foreign tech. Got that. You've got US farmers dependent on Chinese purchases. They're not getting that right now. Is that going to be the deal in a month's time? What kind of deal is that? Chips for soybeans?
Yeah, that's going to potentially unnerve some of the Chinese hawks in the administration. But right now, this is going to be politically uncomfortable for this administration. And by the way, the Wall Street Journal is talking about $14 billion for a bailout. It was $23 billion that was spent for the farmers in Trump 1.0. And they've been talking about this for months because they knew this was going to bite. They're going to have to do something for the farmers because these are red states. These are supporters. And right now, China is not buying cargoes. Potentially, we will get some purchasing at the end of the month when the president sits down with Xi Jinping. But the key question, as you're asking, is what for? What is the bar? Where is the bar going to be? Is it going to be for high advanced technology chips?
Yeah, there's a lot of crossover in all these stories at the moment. Tracking Argentina as well. I believe there's a meeting today taking place. Argentina's filling in the gaps. China needs soybeans, it's getting it from Brazil, been leaning heavily on Brazil, filling in the gaps coming from Argentina, and Argentina wants the help of the US government.
Exactly, and this is why you're seeing these two heads butt in terms of Secretary Brooke Rollins and Secretary Scott Bessent. Treasury Secretary Scott Bessent, I was with him when he met with Milei in April. They are talking about trying to give Argentina this swap line to make sure that they can help Argentina when you have a run on their currency and a run on their stocks. Meanwhile, Argentina just basically opened up the floodgates and sending their soybeans to China. They're filling some of the gap that China has right now because China's not buying from the United States. So this is going to be another politically uncomfortable moment for this administration. Do you want to make America great again, or do you want to make Argentina great again?
Look out for those talks taking place a little bit later between Argentina and the Treasury. Let's get to Tesla. I promised you an update. Shares recovering this morning, higher by a little more than 1% following yesterday's slide, which followed the company reporting record third quarter deliveries. Dan Ives of Wedbush maintaining his outperform rating and writing the following: with Musk now driving Tesla into its next stage of growth as wartime CEO, we estimate the AI and autonomous opportunity is worth at least $1 trillion alone. Dan joins us now for more. Dan, welcome. Let's just start with yesterday's move, then we'll get to the future and all that great stuff. How much of that story with the deliveries was just a massive pull forward in demand?
I think probably about 30% of it was maybe a pull forward, relative to the incremental beat. But look, the demand story is stabilizing. And now I think you're starting to see that turnaround happen. But as we've talked about, that's just the appetizer. The main event, it's the AI revolution coming to Tesla with the autonomous and then the robotics piece. I think this is going to be a $3 trillion market cap. That's why I think $600 is almost a base case for where we see it.
So, Dan, you understand the tension well. I feel like we've covered this together a million times. But it's the tension between the near-term fundamentals and the long-term hope and dreams. The fundamentals at the moment, when you say the demand story is stabilizing demand is not the kind of story we'd associate with a multiple like the one on Tesla right now. Now, Dan, how are we going to resolve those issues? Do we just keep the faith in the multiple and the stock and the hopes and dreams? Or at some point, do we have to reconcile these issues?
Yeah, it's a great point. Look, you're going to have 10 million Teslas, on the road, when you think about it since the beginning. The autonomous value, as you start to see robo-taxis deployed 30, 35 cities, you see full self-driving get to 40, 50% of the actual Teslas out there. That's the game changer. Because ultimately, I think they're going to own 80, 90% of the autonomous world over the coming years as we get to true, what I view as level 4. Look, I think that's the reality. I think investors are looking, autonomous is truly what I view as really the Goldilocks scenario for Tesla, because AI, physical AI, there's two great physical phenomenal AI plays out there. It's NVIDIA and it's Tesla when it comes to physical AI.
When it comes to EVs for Tesla, one of the biggest competitors is BYD, which is absolutely crushing them in Europe. When it comes to autonomous, who is going to be their biggest competitor? Is it coming from China?
Look, I think it comes from China, ultimately, when you think about all the technology, innovations that we've seen there. But globally, no one has the scale and scope of Tesla.
Not BYD?
That's why, look, I think BYD is obviously going to be the main competition. But when I think about scale and scope globally, especially not just in the U.S., but what we see around the world, I think Tesla continues to win that battle. But we don't view this as one where there's just one winner. And I think when you think about autonomous and you think about this next wave of AI, from the chips to the software to the ripple effect, it speaks to our view, like this AI revolution, we're still in the second inning of a 9-inning game, and ultimately the Yankees end up winning that game.
Don't encourage it, Dan. We'll get to that later. Dan, let's say you're right. Let's find some common ground. The autonomous opportunity is massive, driverless vehicles, all of that stuff. I think a lot of people can get on board with that. But I want to understand why you think the Tesla path, that road, is the road to success. So they're using cameras, Waymo's using LiDAR. What kind of technology do you ultimately think wins out?
Look, I think it's ultimately Tesla. From a data perspective, when you look at the AI engineers and you look at all the improvements that they're going to make on these next,
So Dan, let's just give me a second. What data are you looking at? Because I can go off the weekly trips that Waymo's doing at the moment, and that kind of data looks pretty decent. What are you stacking that up against?
I look at as Waymo, they're $200,000 cars in essentially 5 cities. The scale and scope that Tesla has, given the millions and millions of miles driven and the 10 million vehicles on the road and everything that they're doing in Musk as being wartime CEO. That's where I think we sit here 6 months from now. The breakthroughs will happen. And ultimately, when it comes to scale, especially when you look at robotaxis and cybercabs, no one's going to be able to match Tesla. I view that as just basically almost fact as it plays out.
So, Dan, when it comes to deliveries, they don't even matter anymore because everyone's so focused on what's going to happen in the future?
Look, they matter in terms of just, we'll call it, I guess, a signal from a stabilization perspective, especially after what we've seen over the last 6-9 months. But I think from an investor perspective, it's all about, like, to what Ferro's talking about, just like, give me marks on autonomous. Show me the technology innovations on the AI story. Show me that we're going to get to full scale on Optimus. Show me in November at the shareholder meeting that they're going to have a big piece of XAI. I mean, that's why you see Musk, it's a different mode now. It's that wartime CEO that we're seeing. Those are the marks. And that's how we're going to be looking at 600, 700, and ultimately, a stock, I think, $3 trillion.
That's a lot to play for the road ahead. Dan, before we leave you, the baseball, you want to finish there? Yankees win, getting it done. Who do you think gets this all done? World Series later this year?
Look, I mean, I think Yankees obviously have a great shot to go. I think they're going to surprise many out there. I think this could be their year. And look, Annmarie there obviously is a good luck charm, so we got to see how it all plays out.
Have we given up on Penn State, Dan? Are we done with that now?
Oh, no. Look, I'm here in Pasadena, UCLA, the bounce back starts. That's another one. Penn State Yankees at the end. They'll be holding that trophy.
We'll see. Dan, it's good to see you. Thank you, sir. Dan Ives of Wedbush.
We're set to advance. We have the game coming up this Saturday with the Blue Jays. It's going to be challenging, but I agree with Dan. I mean, this pitcher yesterday, this 24-year-old who I just found out is actually from Boston, this kid Cam, was unbelievable. And it's like he came out of nowhere at the perfect time.
Taking down the Red Sox. That's your latest sports segment, with a bit of Tesla sprinkled in between. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A British citizen of Syrian descent was named by police as the attacker on a Manchester synagogue during Yom Kippur services. 2 people were killed, one by an accidental police bullet. 3 others were injured. UK Prime Minister Keir Starmer warned against rising hatred and anti-Semitism, calling the killings a terrorist attack that attacked Jews because they are Jews. Suspensions of flights at Germany's Munich airport are now easing. Several drone sightings prompted diversions of more than 30 flights from the country's second largest hub. This comes as several drone incidents across Europe temporarily forced closures and large-scale diversions at major hubs. And you've been saying it, the MLB wildcard round finished up last night with the New York Yankees shutting out their rival Boston Red Sox 4-0. Yankees rookie starter Cam Schlittler struck out 12 batters and got some key help from his defense to send New York to the division series. Elsewhere, the Chicago Cubs and Detroit Tigers both won their Game 3 matchups to advance to the next round, which starts Saturday. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. Another update on the Yankees. We're done now.
There's another play that everyone needs to watch when the third baseman ran to catch a foul ball and tumbled, literally somersaulted into the Red Sox bullpen. You have to watch it. It's incredible.
I apologize to our friends in Boston this morning. Good morning to you. Up next on the program, payrolls on pause.
We have this shutdown dynamics right now, and it's very difficult to look at the data without having the data.
Some of the other private sources of data will be more important. With some of the government data delay, I don't think that the Fed is going to just, totally go on pause.
Up next, we'll catch up with Sarah House of Wells Fargo, live from New York City. You're watching Bloomberg TV. The Federal Reserve's worried about growth. Markets focused on something else. This came from Torsten Slok earlier this week from Apollo. The US economy remains remarkably resilient. Upside risk to inflation are growing, particularly if the Fed continues to cut interest rates. And based on recent commentary, they will. And there seems to be a difference between what the Federal Reserve is concerned about, downside risk to employment, and what this market is focused on. This came from Ian Linger of BMO. Thanks, Mike McKee, for sending this over. He basically asked his readers, are you more concerned about the Fed missing on the inflation or employment side of its dual mandate in the near term? A, inflation, 63% of respondents. B, employment, 37% of respondents. That's the divide, and it's obvious what the Fed's bias is right now, and the market gets it.
Right. The Fed's bias right now is to the jobs report, not what these individuals are concerned about in this survey, which is inflation, which, by the way, how many years has it been now? They've been continuously missing on their inflation target.
Losing count.
Yes. And at the same time, we could have inflation at 3%, and this Fed potentially could still want to have this bias to cutting because they're concerned what's going on in the labor market. At some point, you have to think about what Governor Myron's been talking about and what Mohamed El-Erian's been talking about for years. Maybe you just need to capitulate and accept you're not getting back to 2%, and you're going to have to target a range between 2 to 3%.
Will they deviate from the dot plot? Nomura thinks they ultimately won't. We'll get into that story in just a moment. If you're just joining us and want some price action, it's still positive, up by 0.2% on the S&P, following 5 days of gains on the Nasdaq, up by 0.24 on the small caps. The Russell this morning higher by 0.37. Under surveillance this morning, it's payrolls on pause.
We have this shutdown dynamics right now, and it's very difficult to look at the data without having the data.
I think it's going to be weeks, not days. This means we're flying blind in a highly foggy environment.
Some of the other private sources of data will be more important with some of the government data delay. I don't think that the Fed is going to just, totally go on pause.
So here's the latest this morning. Investors digesting alternative economic data suggesting the labour market stalled in September, with the payrolls report delayed by the government shutdown. Joining us now to discuss is Sarah House of Wells Fargo. Sarah, welcome to the programme. Nomura thinks that given the data delay, this Fed ultimately won't deviate from the dot plot. Would you agree with that?
I think that's generally right, but we still could get this payroll report before their next meeting on October 29th. But I think absent this most familiar and persuasive piece of labor market data and potentially inflation data as well, it's hard to really see Fed officials adjusting their prior view. So I do think that keeps them on track for another cut here in October.
Sarah, I'd rather have the jobs report than not have one. You, I imagine, would agree. But ultimately, over the last few months, the last few years, it hasn't exactly been reliable, has it? How useful is that jobs report to this Federal Reserve?
Yeah, I think overall it's still a very informative picture of the jobs market. So we've obviously had some issue with payrolls being pretty consistently overstated, but you still have a lot of information coming from the household survey, some of the ratios there that are particularly helpful. But at least when it comes to the labor market, we still have a lot of alternative data, some of which has been around for a year. So we're still able to fill in some of the picture. I think the issue right now is that some of those secondary reports, they're not all painting a consistent picture. So we're not getting necessarily a clear signal from them. So it's of limited help right now, I think, to the Federal Reserve.
What are you relying on mostly when it comes to the second tier reports?
Yeah, so I think there's a number of indicators that we've been using for years. We understand how this works with the overall jobs market. So one is what we're seeing in terms of the NFIB hiring plan. So that's one of the bright spots we're seeing in the jobs market right now. So we saw that come out for September yesterday. That's been up for 4 straight months, highest since January. And then the other part that we use a lot are what's happening with the PMIs. So both the ISM employment components, but also the regional Fed ones. And there the story isn't as sanguine. So if you look at the regional Fed services PMIs on average, those hit their second lowest reading of the year in September. So pointing to that mixed messages where we're not seeing an obvious firming, but also not necessarily clear downtrend when we look across the major data points right now.
When does this start to become very uncomfortable for you? If we have a prolonged shutdown, and what if we don't get the October print as well?
Yeah, so I think where probably it gets a little hairier is if you see that shutdown last probably about 2, maybe even 3 weeks, because then again, you're probably not going to see that before the next Fed meeting. I think also that starts to potentially influence the October data. So we saw in the 2013 shutdown that from the employment perspective, response rates were in their normal ranges, so the BLS was able to kind of make up that period. But where it was a bigger problem was in the inflation picture. So back in October 2013, the BLS only had about 75% of the observations. This is, of course, coming at a time when they're already having to impute more data, cut coverage in some cities. And so I think the bigger concern in a prolonged shutdown is the quality of that inflation data that we get in October at what still is, of course, a very tricky time for the Fed in its inflation fight.
Could a very prolonged shutdown put the Fed on hold at any point?
It would have to, I think, be pretty prolonged. So again, I think for now it keeps Fed officials in really what they're in their prior expectations path. And we saw that the majority of officials were still looking for 2 more cuts before the end of the year. If you think about who's voting this year, I think that the bias is even more so towards those 2 cuts. So I think it's really hard to see that them altering that path in terms of forcing them to actually be on hold at this point. But this has been a pretty strange year in terms of what's happening in the policy sphere. So we'll see what happens.
Sarah, we will get some data. We'll get ISM services. Earlier this week, we had ISM manufacturing. How instructive have those indicators been, particularly at a time when this market is positioning for a pickup in economic activity?
Yeah, so less so in the past few years than I think they were prior to the pandemic, but still a decent barometer on overall activity. I think we have to be a little bit careful with what's happening with some of the supplier delivery components of that, where once again, with some of the tariffs, you're still getting some gummed up supply chain issues. So longer delivery times, not necessarily a positive sign for activity there. But with the services number today, I think we'll be looking closely at, does the pop that we saw in new orders hold, or do we get some give back the way that some of the regional Fed PMIs are indicating that maybe that momentum isn't turning around quite as much as what was previously indicated.
Sarah, just before you go, in the commercial break, I was reading a note from Jordan Rochester of Mizuho, and in it he was reflecting on the pandemic. And as you mentioned the pandemic, I think it's worthy of conversation. In that time, we got really used to looking at alternative data. I remember people coming on and talking about open table data, looking for that high-frequency pulse of what was happening in real time. How useful was it then, and do we return to that now?
So I think it was pretty useful then just to help us gauge the magnitude of changes in some of the more traditional data. Right now where we've seen activity kind of get to at least a more normal pace, I think it's a little bit less informative. And then the issue there is a lot of that alternative data, it doesn't have a long time series. And so it doesn't necessarily help as much in terms of turning points in the economy, or at least potential turning points, which we could be at now. So it's helpful, but I don't necessarily think it's a panacea for missing this long-standing government data.
Hey, Sarah, appreciate it. Sarah House of Wells Fargo. We'll do our best to fill in the gaps as we wait for a payrolls report, and we don't have a clue when that payrolls report is coming out.
We don't know because the government is still shut down until they open it up. Then we'll know whether or not they're going to release it in 2 or 3 days. Because remember, this payrolls report is pretty much ready to go. They need to get the press release together, and then they go and ship it out. I believe in 2013, when they reopened, the payrolls report came out 3 days later. After the shutdown. So we will get it soon, but they have to reopen. And this is the question. If this is prolonged, okay, we're not going to get September, and then October's data is going to be a lot rougher to collect, and that's going to be delayed.
We are in day 3, and the jobs report is most likely delayed. Equity futures positive by 0.2%. Looking through the noise down in Washington, D.C. Up next, we'll catch up with Priya Misra of JP Morgan, Jeanette Lowe of Strategas, Francis Donald of RBC, Mike Collins of PGIM Fixed Income. From New York City, the second hour of Bloomberg Surveillance is just around the corner.
Positioning today, despite the run-up in the market, is a source of upside.
Nothing really phases these markets.
AI has been fueling this rally.
We've seen a considerable broadening of the rally. The remainder of this year and into the first half of next year, we feel pretty good about the market conditions.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores are shaping up as follows. Equity futures on the S&P 500 firmer by 0.2% following and building on a 5-day winning streak on the S&P 500. It looks like day 6, and today it won't be dependent on what happens at 8:30 Eastern time, because we are not getting payrolls. In the bond market, 2-year, 10-year, 30-year bond yields shaping up as follows. Your 2-year just about unchanged at 354.50 with yields down on the week. The data we have had so far this week has not been great. The data we will get looks like this. ISM services coming later on this morning is really the main event. Without payrolls, we'll all be looking to ISM.
Absolutely. And you mentioned Jordan Rochester, and he was talking about how we're basically entering a data desert, and how long that lasts is going to be how long the government shutdown lasts. And today we might get some clues. We're going to hear from Speaker Johnson. We're going to hear from Majority Leader Thune. They're going to have another vote on the clean CR. It's not passing, but potentially does a pressure start to build. Remember, people are going to be furloughed. They're not going to get paid. You have 4 Democratic senators sitting in Maryland and Virginia, where a lot of these people live and work, and that work for the U.S. government. And potentially those are going to be the individuals who start to put pressure on Chuck Schumer to start negotiating and wrap it up.
So Ed Mills of Raymond James was great a little bit earlier on this morning. We talked about when America starts to feel this. At the moment, it's just a headline. And for a lot of people, it's a headline they're not paying any attention to. He said it gets real when we reach 2 points. 1, when the military aren't being paid, because that is a very uncomfortable thing to stand behind. And 2, when the airports start getting messy and busy, and your everyday traveler starts to see it for real.
So middle of October, the military is supposed to get paid. Everyone in America is going to want to see men and women of service getting their paychecks. That's one, he's absolutely right. And that's why people think this can only last 2 weeks, right? Because then that would be crazy. Second, there is historical evidence that when people start to get annoyed at the airport, when you have the FAA coming out and saying we're going to basically limit air traffic into things like LaGuardia and Orlando, then we need to wrap it up. On January 25th, 2019, this is what happened. And guess what happened that same exact day? Trump agreed to a temporary government funding measure. Curmudgeon travelers, people take to Twitter. They are angry. Open the government. Why are you doing this to us? That's when it starts to hit.
Are we going to see a repeat of that? At the moment, the market's looking right through the noise. Equity futures on the S&P positive by 0.2%. Coming up this hour, we'll catch up with Priya Misra of JP Morgan, with investors extending a record rally. Jeanette Lowe of Strategas as the Senate holds another shutdown vote. And Francis Donald of RBC seeing data delays leading to a Fed pause. We begin this hour with stocks hitting fresh highs, unfazed by Washington's funding impasse. Priya Misra of JP Morgan writing, the markets seem to be ignoring the shutdown for now, but if we get permanent government layoffs, that can have a bigger impact. Priya joins us now for more. Priya, good morning.
Morning.
I've asked this question about 10 different ways this week. Is it different this time? Do you think it might be?
It might be. There are some differences. Now, we know historically shutdowns have not mattered. What's different this time? The Congress has passed not a single appropriation bill. So this is a full shutdown. And we have the president talking about permanent layoffs, which is, remember, this was the Doge year. So, the administration did come in saying there's a lot of, excess spending by the government. Do they use this opportunity to start to cut Democrat programs? And does that result in the pickup in layoffs? We've been in this low hire, low fire labor market. We were actually looking more at the private sector. Do layoffs start as companies try and protect margins? What if it starts from the government side? Now, I don't know, maybe it's just a negotiating ploy. That's, I think, where the market is. That's our base case. But if it starts to actually, there are layoffs here, I think we have to start thinking that the labor market's much weaker. We're already a little fragile. So I'm not saying it's our base case, but I wouldn't just say because historically it hasn't mattered, this shutdown may not matter.
Is there the demand in the private sector to basically take those layoffs if they become permanent?
No, great point, because the labor market is stagnant. If you have a job, you're not getting laid off, you're not getting paid a lot more. So that's my signal of slack is building up. So wages are not picking up. Trying to find a job right now in the private sector, even without the government potential workers, is difficult. You add more labor supply, I think it's going to be hard, and that's what's going to make the unemployment rate start to pick up. Now, we may be in a shutdown, so we may not know it, but we're going to look at other ways to see, is that slack starting to
Do you have any thinking behind what kind of numbers we could see in these type of federal layoffs that maybe become permanent?
That's the tricky part. Doge came in much lower than what they had come in with. Do they try and get back to like million? We're estimating about 300,000 voluntary retirements have already happened. And you're going to see that in the data when we get the data in the next few months. That's a hard one. I think we just have to watch the president. I'm still hoping it's a negotiating tactic. It's to put pressure on the Democrats. But if not, we'll just have to react to what those numbers are. But I look at valuation. Nobody's really expecting a pickup in layoffs. Look at the stock market at highs. Yep. Bonds are not pricing in a big slowdown. They're just pricing in moving to neutral. So I think the market will react to this.
So, Priya, that's the tough one for you, really, for market participants. Economists just have to go through one stage. You have to go through two. Guess the data, then guess how the market responds to it. So at the moment and over the past few months, ever since we got that July payrolls report in August, things started to look weak, fragile. Then we had all these revisions, massive step down in payrolls growth. But the market kept on climbing. Both equities and credit pricing in a re-acceleration, an expansion. Do you think maybe that weak data starts to become bad news for this market?
I think weak data is always bad news. Unless the Fed is super aggressive, taking rates to zero or below neutral, and we're not pricing that in. So if you get really weak data, I think, to some extent, the re-acceleration is a narrative that's trying to fit price action. So I look below the hood, and I'm not saying you're doing that.
Not at all. I can take it, Priya. Carry on, please.
There is a view that we're re-accelerating. Where in the data do you see the re-acceleration? So the stock market, credit spreads, I get that. The stock market, let's look under the hood. It's really an AI story. GDP, you strip out AI from investment, GDP is about 0 to 1%, depending on how much you want to strip out AI or how you calculate that. We're not re-accelerating. Now, you go out 6 months and the one big beautiful bill provides some fiscal stimulus. And if we get certainty, remember, I know we don't want to talk about tariffs, but we're still seeing tariff announcements every week. And so if you get certainty on tariffs, this is the trade deal. Now, as a company, I can figure out what supply chains are. Maybe you get that re-acceleration. So I'm not negative long term, but right now we don't see signs of re-acceleration. We see signs of soft landing, sub-trend growth is what bond people call it, where you're growing between 1 and 2%. Inflation, a big fear after Liberation Day, has not really materialized. So the Fed is saying, okay, we were worried about those risks. Now we're looking at the labor market. Maybe we start to take rates down to neutral. And that's why I don't think there's a very big disconnect. I think every market is pricing in this AI structural theme. And then some cyclical slowdown, which is allowing the Fed to take rates down. But if you start to see the cyclical side accelerate, to your question on if you start to see bad news on, we don't have payrolls, but something, or claims, sure, something else, then I think the market's going to say, okay, maybe this is slowing down. And what will a couple of rate cuts do? I think that question then starts to unwind some of the spreads.
Allow me to put it another way. Some tension between corporate earnings and the labour market. That's real. That really is real. Do you think that tension can persist?
I think that is the trillion-dollar question. So how did corporates deal with tariffs? They stopped hiring. I think we were looking at, do they pass on the cost or do they absorb it in margins? Margins have stayed strong. One of the reasons why corporate spreads are tight is fundamentals of company balance sheets are strong. Do they continue? I do think the tariff rate today is higher than it was a few months ago. So will companies take the margin hit? Some might, but overall, I think companies might continue to keep hiring low. That's why the labor market is weak, because hiring is low. Now, if they're able to pass on costs, I don't think the consumer can take it. I mean, at the margin, certain areas they can pass on the prices. So I guess a long-winded way of saying that tension may not be able to last for too long. I don't know about second quarter, third quarter earnings. Maybe it's an early next year phenomena. But at what point do companies say, I'm facing higher tariffs, I'm going to actually have to lay off people? I think that's the tail risk scenario. And if the layoffs start, I think then we're talking about the Fed needs to cut well through neutral. We can debate what neutral is, but at least below 3%. And then I think you get a bigger move in rates. And then the equity market has to figure out, how much of it is AI versus everything else. But that tension, I think companies have tried to do more with less and tried to pay for tariffs through lower hiring.
What would be the catalyst for the firings? Just they can't absorb the higher costs anymore?
And they can't pass it on. If they have a view that the consumer is not willing to pay, I'm sure they'll try and take some in margins. They'll try productivity, other productivity increases. But the other way would be, well, maybe I just, so far I have not hired. Maybe I now start to cut costs by laying off. That's what American companies do. We have a dynamic labor market. historically, slowdowns have happened when companies say, I'm going to have to cut costs here. And this is the fastest way to cut costs is actually lay off people. I should say that is not our base case. We're hoping that companies can be innovative and not have to lay off people. Maybe they find some AI way to raise productivity. I think that is the big question. We've seen all the AI investment. Do we get the AI productivity that allows companies to keep the people, not have to lay off people, absorb the tariffs, and get the productivity increase through automation?
Was this an argument to extend duration?
Absolutely. And this is very different from where we were April 2nd when I was saying, stay away from the long end because there's a lot of this. Sell America, there's the deficit. Number one, the deficit's better today. We're raising a lot in tariff revenues. That's going to improve the deficit. Not long term, but at least over this year. The market's pricing in that. The other question about the long end is what are we pricing in? We're pricing in the Fed cutting to 3% and staying there. And then term premium, which is what we define how much extra compensation are you getting for extending out the curve. That has gone up. So I think extending from the 5-year to the 10-year makes sense. For the 30-year, I still want to see something from the US Treasury. I think they need to cut supply in the long end. There just isn't a global, and it's a global question, demand for duration. So I don't know about extending all the way to the 30-year, but the 10-year, I think at 4%, our view has been in a soft landing, 3.75 to 4.25. But there's asymmetry to that. If there's a slowdown, I think rates will go much lower, and that's when you want some duration.
Just quickly, if the Fed paused balance sheet roll-off, would that make any kind of incremental difference to you?
At the margin, it's a little less supply if they stop QT. QT is running at a low rate. I do think it's good news because the front end then can calm down. We've seen some pressure in SOFR, some pressure in Fed funds. So I do think and we're watching the minutes for that. I'm pretty sure there was some discussion around QT. And maybe they'll signal that in the next meeting or two, they're going to cut QT. At the margin, it's positive for duration. It's also positive for risk because it prevents that deleveraging. Remember September 19 when repo rates spiked? It takes that tail risk off if they were to stop QT, but it's a smaller.
Always odd when they're allowing balance sheet roll-off and reducing interest rates simultaneously. I've always found that.
Well, if you're going from restrictive to neutral, you can continue balance sheet runoff in the background. If you go below neutral, now you're accommodative, it makes no sense to be doing QT. But that's how the Fed can still reconcile doing QT. It's in the background. We're just taking rates from, we're taking the balance sheet from excess reserves, or their term of abundant to ample. But we're just, and I think that's the theme. We're just taking restriction out. So October, I think the Fed's cutting, even if the shutdown lasts for a while, because in their mind, they're just taking some restriction out of the market. I don't know about next year. If this shutdown lasts for longer, I think that's when it gets harder.
Well, then we've got a new leadership story at the Federal Reserve and a much longer conversation. Priya, it's good to see you. Thanks for dropping by. Thank you. Priya Misra of JP Morgan. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Chinese tech giant Huawei was found to have used foreign hardware in its AI processors. Semiconductor watchdog Tech Insights discovered gear from Taiwan's TSMC, along with Samsung and SK Hynix, in multiple samples of its chips. Huawei didn't respond to a request for comment during a week-long holiday in China. Apple's App Store removed IceBlock and other applications used to report and track sightings of U.S. immigration and customs enforcement agents. This after Attorney General Pam Bondi urged the iPhone maker to remove the software. IceBlock's developer maintains it's not different from other software that relies on crowdsources data. BlackRock's Global Infrastructure Partners is said to be in advanced talks to acquire Aligned data centers. Aligned could be valued at about $40 billion. The deal would be one of the biggest for the year. A spokesperson for BlackRock declined to comment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, ending the government shutdown.
We have conversations, and I'm assuming we'll have more. Back in tomorrow, we'll have another opportunity to vote to end the shutdown tomorrow.
Leader Schumer and myself haven't gotten a single phone call as it relates to a follow-up conversation.
That conversation up next with Jeanette Lowe of Strategas, live from New York City this morning. Good morning. Equity futures on the S&P positive here by 0.2% on the S&P 500. On the Nasdaq up by 0.2% also. Typically I'd sit here and say 1 hour 13 minutes away from the payrolls report, but we're probably not going to get one unless
someone... You miss a countdown, don't you?
I love a countdown. Unless someone springs a surprise on us.
This is true. I mean, I don't want to go into the conspiracy theories, but there is a theory out there that
the NEC's got the number.
The NEC director has the number, and then he would have briefed the president last night or this morning. So if the president does have the number, does he do his own payrolls report release at 8:30 on Truth Social? Stay tuned.
Can you imagine?
That would be something.
We would
cross a Rubicon in this country.
Let's just put it this way. That's not the base case this morning. The base case is we're not expecting a jobs report at 8:30 Eastern Time. Under surveillance this morning, ending the government shutdown.
We have conversations, and I'm assuming we'll have more. Back in tomorrow, we'll have another opportunity to vote to end the shutdown tomorrow.
Leader Schumer and myself haven't gotten a single phone call as it relates to a follow-up conversation.
The issue set is pretty straightforward. I don't know that, a negotiation is going to accomplish a lot.
We need credible partners on the other side of the aisle.
So here's the latest this morning. The US government shutdown entering its third day. The Senate preparing to hold a vote on a stopgap spending bill to reopen the government. Bloomberg's Laura Davison joins us now from Washington for more. Laura, you've tracked the story all week for us. What's the update? It's day 3. What's going to break this deal ultimately on day 4, 5, 6, 7, 8? It's going to take 10, 15, 30 days? I've got no idea.
The thing that to watch here are what are moderate Democrats in the Senate doing. Leaders Schumer and Jeffries are not talking with Johnson and Thune. There is essentially no progress 3 days in. The question is how much pressure does Trump and the White House put on Democrats? They've threatened these firings. They've threatened to cut more spending. That has not yet materialized, but that could very well come later today. The other question is lawmakers are going to vote again and then go home for the weekend. What kind of pressure are they getting from constituents? We will basically start next week. They'll come back to the Capitol Monday night. And, we may very well be in the same place we are now of there is no progress. And you start to see some of these moderate members who are worried about their reelection come next year say, hey, we need to get something started. We need to move our position, talk about health care, talk about, kind of what sort of things we could take, whether that be a future vote or other options, because this is not a politically tenable situation.
Laura, what is incentivizing those moderate Democrats at the moment?
Right now, they believe that once these notices start going out, informing people that their premiums are going to increase, that public sentiment will be on their side. That's the gamble that Schumer has put out. We'll see if that materializes. But if they start to see that, sort of anger and frustration over healthcare costs, are dwarfed by anger and frustration over the government shutdown and services not being available and people just feeling generally, frustrated that Washington isn't working. Those are the two things they're weighing. And how much a shutdown will affect the midterm. Right now, they're betting that people care more about health care when the midterms are a year away versus, sort of a little bit of chaos in Washington for a week or two.
Laura, thanks for the update and thanks for covering the story for us through this week. I imagine we'll be talking to you again on Monday. Laura Davison there of Bloomberg down in Washington, D.C. Jeanette Lowe of Strategas joins us now for more. Jeanette, as you know, as is often the case, this is won or lost in the court of public opinion. Who's winning and losing right now?
Yeah, right now, I think if you look at the polls, you do see that Republicans are getting a little bit more blame than Democrats are currently, but both parties are getting a hit from this. And in general, we do see that both parties generally do get some backlash for a government shutdown. The same thing happened in 2013 with President Obama getting some of the blame, even though Republicans kind of put the government into a shutdown. So both parties may ultimately suffer from this, and that's how they kind of have to figure out who's suffering more is where the pain point may be to actually get the government to reopen.
Jeanette, what do you see as the off-ramp?
So this is going to be kind of a difficult situation. So the parties are kind of far apart right now. The Republicans do agree that probably something does need to be done to extend the ACA subsidies, probably a short-term extension, maybe a year with some amendments, some reforms to the process. And so the Democrats are pushing for that, but the Republicans are also saying that they can't do anything until the government is reopened, while the Democrats are nervous that the Republicans will not hold their word on this. So So what we're thinking is that probably what you're going to have to see is either some major political pressure coming in, which would mean we're seeing missed paychecks in the middle of the month for military members, for congressional staff, which will also put pressure. But then also, do the moderate members come together to figure out how they can figure out some sort of agreement to get us out of this shutdown? It probably will have to be in some form around the ACA subsidies. The longer this goes on, this could last 2 to 3 weeks, just depending if we don't see any momentum towards a deal. As we get later into the month, you have the missed paychecks. That adds pressure. You start to maybe get some of these premium increase announces. That will add pressure. And that could be where we see the ultimate solution.
Well, the Republicans already picked up 3 votes in terms of the Democrats willing to vote for the clean stopgap funding measure. Who else should we be looking at?
Yeah, I think you look at retiring members. So members like Senator Shaheen from New Hampshire, Senator Peters from Michigan, also watching the Virginia senators, since they have a significant portion of the federal workforce in their constituencies. Those will also be key members to watch. So we would want to see if they have a vote today. Do more Democratic senators join on to the clean CR, or do we go into the weekend and have no movement at all? If we do see more Democratic senators join, then obviously that would be showing a sign that there is more pressure to get to a deal at some point. But if we don't, this could definitely start to linger a lot longer into next week and potentially even the following week.
And how are you thinking about the president's meeting with Russ Vought yesterday and whether or not he was going to be making layoffs that usually historically are just furloughs and those individuals come back to their job permanent?
Yeah, I mean, this is obviously at least a threat. So this is something that they think the administration would like to do, and they see this as an opportunity. This is one of the reasons that Democrats were actually worried about having a government shutdown in the first place, because they thought that this could be a tactic that the administration would use. But then at the same time, you're also seeing Democrats getting some support among federal worker unions, saying it's okay that you're doing the shutdown because we know we're under attack anyways from this administration. So there's a little bit of, we could probably definitely see some layoffs, some permanent layoffs, but then they also may be challenged by the courts. And that also could play into public opinion as well. So that also could be something that, depending on how these play out, that could be key to which side actually gets more blame and where the pressure ends up being longer term.
Jeanette, appreciate you jumping on this morning. Busy one for you, I'm sure, going into the weekend. Jeanette Lowe there of Strategas with the latest down in Washington, D.C. Just got a message from a Bloomberg subscriber. Aren't people numb to this in this country, given the chaos, the disarray in Washington, their opinion of Congress already?
Shutdowns, debt ceilings, the opinion of Congress and how low people rank what goes on in Washington, D.C. Yes, but it also does matter. Jeanette, what she said, Ed Mills, what they said, middle of the month, when those paychecks are set to go out to service members, that's going to be a big deal. If those paychecks do not go out, if your flights continuously get delayed, that's going to be a big deal. If the FAA is saying, we just don't have the staff and we can't keep up with this traffic because we have furloughs. This is when it starts to really bite.
This can cascade through the economy pretty quickly. And the question we've got to ask following the economy and ultimately financial markets, is it economic activity delayed or derailed? We're going to ask that question next. We'll catch up with Francis Donald of RBC as the data delay threatens interest rate cuts from the Federal Reserve when they get round the table together for a 2-day meeting at the end of this month. No payrolls report this morning, most likely. Will we get it in a few weeks' time before they meet? Plus, we'll get some morning movers for you. Danny's going to join us. Taiwan Semi rising on a new connection with Huawei. Their stock is up by 2%. Live from New York, you're watching Bloomberg TV. Five-day winning streak on the S&P 500. Looks like day 6, at least for now, positive by 0.1%. In the bond market, switch at the board. We'll turn to fixed income briefly. 2-year, 10-year and 30-year bond yields just about unchanged. Twos are down on the week, though, because the data hasn't been great. 354.50, particularly ADP, but that's all we've got to go on. Then we're looking for payrolls. We're not going to get that. You're going to get the ISM a little bit later this morning. That's the next stop. 10 a.m. Eastern Time for a read on ISM services. That's the state of things right now as we count you down to the open, about 2 hours away. Let's get you some single names, some stock movers. Here's Danny with more. Hey, Danny.
Hey, John. TSMC, the U.S. ADR, rallying this morning after a tear down by one company from Canada on the latest Huawei chips. It shows that they use basically all Asian suppliers from SK Hynix to Samsung. And yes, TSMC chips are included in that. So rallying off the back of that about 2% higher. Also a rebound this morning for Tesla. Shares fell 5% yesterday, even though they came out with record sales. The issue is it seemed like consumers were rushing to buy Tesla to get ahead of the expiry of the $7,500 tax credit for EVs. Of course, the Trump administration phasing that out. So was it just a temporary sugar rush? Shares fall, and we're buying that dip this morning, only up by 1.1%. Meanwhile, we are looking at another rare mineral company rallying this morning. That's USA Rare Earth Inc. A CNBC report that they've been in talks with the Trump administration and were specifically asked whether they'd want to do a deal with the Trump administration. This follows off the back of the administration looking at other deals with other rare earth mineral companies. So those shares up 2.4%, John.
Danny, thank you. More from Danny in the next hour, about 60 minutes from now. On a radar this morning, some of our top stories. The government shutdown delaying the release of September payrolls. Many economists are leaning on alternative data, and some predicting US job growth is slowing. Elsewhere, Bridgewater Associates' flagship macro fund climbing 26% this year with a boost from tariff-fueled market uncertainty. Sources telling us here at Bloomberg the hedge fund is on track for its biggest gain since 2010. And finally, this story right here, potentially quite controversial. Argentina's economy minister and central bank president traveling to Washington today to negotiate a proposed $20 billion FX swap. Treasury Secretary Scott Bessent saying the U.S. supports President Javier Milei, but the aid is not an outright U.S. investment.
So they're trying to give an olive branch to Argentina through this FX swap, which, by the way, wasn't on the table when I sat down for the Treasury Secretary in Argentina in April. It's now on the table, and it comes at a time when Argentina is sending soybeans to China, and China is not buying any cargoes from the United States. And this is why this has become politically a ton of tension within this administration between Secretary of Agriculture Brooke Rollins and the Treasury Secretary Scott Bessent. I said it last hour, I'll say it again. For this president, this might become a problem. He wants to make America great again. At this moment, people are viewing this as making Argentina great again and their ability to fill the U.S. gap and sending soybeans to China.
So some tension in the cabinet. So let's talk about where the president stands on this. The president at the moment is talking about bailing out the farmers who aren't getting those soybean purchases. In the negotiations with the Chinese later on this month, he's going to have a conversation about boosting those purchases, maybe returning back to the purchase program, the agreement of the president's first term. What's he saying about what's happening with Argentina? Have we had a response from him? Have we had a response from the Treasury Secretary?
Well, the Treasury Secretary is saying that this isn't outright money. So they're trying to say, like, look, this is a financial instrument to help them. This isn't outright money. And they're going to have this conversation today with the finance minister in Washington. This is going to become a little bit more challenging for the president when Javier Milei is in Washington, according to reports, in about 2 weeks' time, alongside the IMF World Bank meetings. And if the government is still shut down and they haven't given the bailout yet, the Wall Street Journal is talking about $10 to $14 billion to the farmers, then potentially the heat is going to be turned on.
At the moment, the government is shut down. It's day 3, which means we're not getting that payrolls report in about 60 minutes from now. Francis Donald of RBC has this to say. The timing of the government shutdown is not ideal for the Federal Reserve. Limited visibility into the September data increases the probability of an October pause. Francis joins us now for more. Francis, good morning. It's good to see you. So this is a slightly different take because we've had a guest come on the programme and say they're not going to deviate from the dot plot. Ultimately, they're expecting a rate cut still in October. Why would this lead to a pause?
Well, let's remember Chair Powell has talked a lot in the past when you're walking in a room and it goes dark, you go more slowly, you don't necessarily speed up. And at the end of the day, we have to remember this shutdown is compounding an existing problem, which is that our data is being substantially distorted by by tariff developments, front loading, inventories. We know that companies, clients that we talk to and others are finding ways to navigate around that using things like bonded warehouses, for example, or changing the timing of their purchases. And then on top of that, now we're going to miss probably a month of solid evidence as to what actually happened in there. So from our point of view, just like a company or a consumer at the end of the day is maybe going to say, let's be a little bit more cautious. To us, this is going to raise more questions than it is make it very clear what the definitive path ahead should be.
So Annmarie was talking about this earlier on this morning. The data itself has been a problem. How dependable is the data anyway for this Federal Reserve?
Well, this is the thing for economists right now is there is already a giant question mark around what data should we be using? Are there biases within the data? Were there? Will there be on a go-forward basis? We've already for years been dealing with low response rates, and we know that the economy is operating in a way that changes the way we need to use data. Confidence data, for example, in our view, is still very valuable. It explains how consumers are feeling, but if the top 10% of consumers are spending 50% of all of the consumption, then confidence data is not the same valuable tool it was in the past. Layer on top of that tariffs, and we've been really in a dark place with respect to how we can read visibly. And that's why, in a way, John, I'm not that upset that we're going to miss a month of data because I think there's so much obsession over this month to month, in part driven by the Fed that's highly data dependent. We need to focus on some of the bigger trends, and the bigger trends are clear. This is a labor market that is structurally very different. We don't need the same amount of job growth as we did before. We only believe that this economy needs to create 40,000 jobs a month for the unemployment rate to stay stable. We know growth is slowing off the back of tariffs and some price pressures that are coming through, and we know inflation is likely to reaccelerate into year end. And I could, for a month, go dark on data and tell you that I'm still fairly confident that will be the story 30 days from now. But when, of course, we're hypersensitive and we're in an environment where policymakers are really trying to move month to month, of course, the market is going to feel a little more uncomfortable with that lack of visibility.
Are you saying the Fed is too data dependent?
Well, no, what we're saying is that the month-to-month variability in data, this has always been true, sometimes leads us in the wrong directions. And I think what's really challenging right now is that that tariff distortion is very much still in play. We hear all the time, oh, tariffs are not inflationary. That may turn out to be true. It's not our view, but we won't know that till the middle of 2026. So the issue with data dependence right now isn't data dependence in and of itself. It's data dependence in an environment where we don't have good reads, and our month-to-month data is not telling us the true story of the American economy or the American consumer.
So what do you look at on a day like today? You're not getting the jobs report. What's your North Star in terms of directing you towards these trends?
Well, today's not actually the problem. So any economist would have released their estimate for where jobs would be last week and everybody's week ahead. Our estimate was 52,000. The problem will be next month when we don't have the aggregate amount of data that helps us forecast what happens next. At the end of the day, we tell clients focus on the trend. We think the unemployment rate will rise gradually to 4.5%, 4.6%. But we've been through a few cycles, all of us at this table, if I may say that. We know that 4.6% unemployment is still very low, very tight labor market underneath the surface. So we are doing what we've been doing for the last year. Much more bottom-up work, much more sector focus. Look at your actual end consumer. Which one are you servicing? Which one are you investing in? And look at their individual stories. And then, of course, we have a table of all the indicators that we look at, from WARN notices to LinkedIn postings, that help us get a little bit more of a month-to-month gauge. But the message here is actually one of relief. Focus on the big picture. That's probably going to guide you towards better investment decisions and better operating decisions if you're running a business.
You'll forgive me for bringing up the shutdown then, but we do have to talk about it just a little bit. The government shutdown in Washington, it can have implications for the economy. Typically, we know how the movie goes. Economy has a bit of a blip. Then we accelerate, we pick up again, and we look through the whole thing. And that's ultimately how markets play this story too. Do you see it as delayed, deferred activity, or are we at this point where things are a little bit more fragile, where things could be somewhat derailed?
Well, I watch your show in the mornings, and I'll repeat what just about every economist has told you. Our traditional rule of thumb is the shutdown is worth about 0.1 percentage points of GDP each week that it goes on, and then it becomes nonlinear, likely around the middle of the month. The longer it's out, the more it bleeds through the economy. We're focused on some of the things related to contract workers as well. So all the economy that circulates around the government that may see a pause. At the end of the day, I talk about the shutdown being emblematic of larger trends, and there's two that sort of worry us. This economy was already slowing down. So these additional bumps, they exacerbate the problem, they exacerbate the uncertainty component. But under the surface, we've also in the past year, again, we're thinking about how this relates to the bigger trends, been much more focused on the fiscal side of the picture, the policy side of the picture, than the monetary policy side of the picture. And that's largely because this economy is becoming less sensitive to the Fed's next move and much more sensitive to what's happening in Washington. We see this in the yield curve. We see this at the long end of the curve. But many Americans are leveraged to the belly and the long end of the yield curve, with the Fed is not successfully being able to influence at this point of view. So acrimonious Washington, to me, is not necessarily about the GDP impact for September and October. It's about this transformation where we move away from monetary policy being the core driver of the business cycle and realize that if we really want to know where are we have to watch fiscal spending, the deficit, and the path for that ahead.
Is this shutdown different, though, if Trump decides to make these furloughs permanent?
Oh, absolutely. And so when we look at the numbers, for example, if we were to see, and this is the extreme example, this wouldn't happen, but if by October 17th, that'll be the reference week for next month's job number, if we haven't seen folks come back, you could see the unemployment rate jump to 4.8%. Now, our estimate is that it would then come back down, but these are the types of numbers that begin to skew the story to a certain extent.
I'm saying if he decides to say, I actually want to move more people into the private sector and I'm getting rid of these offices, these jobs, isn't that more of a permanent effect?
Absolutely. That would be more permanent, but that number is ultimately probably going to be quite small. But the most extreme thing, let's say every person would be laid off, which is not going to happen, you would see that number jump to 4.8. Again, this is emblematic of the bigger picture, which is job growth is slowing. We are going to see less job creation on a go-forward basis, with the exception of healthcare. Healthcare is going to continue to be fairly robust there. So this is the trend continuing: slower job growth, slower overall growth, less confidence in the economy, and reduced data visibility. It is, as we say, stagflation light.
Francis, you're one of the best. Appreciate it. Absolute clinic as always. Francis Donald there of RBC, and the jobs report we won't be getting, and the trends you need to focus on. Equity futures right now in the S&P 500 positive by 0.2%, with an update on stories worldwide. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Goldman Sachs CEO David Solomon is bullish on the U.S. economy. Speaking to Bloomberg's Tom McKenzie earlier in Italy, Solomon said he sees tailwinds such as tech spending helping the United States.
The U.S. economy is in pretty good shape. And there are some very, very strong tailwinds that have really had a profound effect. I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026.
Just last month, Solomon warned President Trump's trade policies were weighing on growth. Another setback for Boeing. Sources telling us here at Bloomberg the company's 777X jet will fly commercially in 2027 instead of next year. The delay could result in potentially billions of dollars in accounting charges. The jet is already 6 years late and has major strategic and financial importance to Boeing. Are you ready for it, Swifties? Taylor Swift's highly anticipated 12th studio album, The Life of a Showgirl, is out now. The album features 12 tracks, with the title track featuring Sabrina Carpenter. Swift's latest album is the most pre-saved in Spotify history, surpassing 5 million pre-saves. We'll have to keep an eye on shares of Spotify later. That's your Bloomberg brief, John.
Bonnie, thank you. Appreciate the update. Thank you very much. Up next on the programme, divisions remaining at the Fed.
We're going to go off of what the data we have. It suggests that the unemployment rate was unchanged. I think it indicates some steadiness in the labor market. And I think the underlying economy is still growing pretty solidly.
Up next, Mike Collins of PGM, live from New York. You're watching Bloomberg TV. Equities are positive, higher by 0.2% on the S&P 500. On the Nasdaq 100, up by 0.2% also. 5-day winning run on the S&P. Looks like day 6 already, the longest daily winning streak since the end of July. A lot of bulls have come on this program, but a lot of people have come on the show so far this week and really explained why this is such a risk-friendly moment. Krishna Gua of Evercore saying because of this growth-labor divergence, it looks like the growth side is fine. The labor side is perhaps weakening more. The Fed is taking its cue from the labor side. And that's why this is so risk-friendly. And Mike Powell of BlackRock was saying something similar. Strong growth environment with labor market weakness giving the Fed more room to cut. That's a positive backdrop for risk assets.
And you just heard from Frances Donlan. What is she talking about? The trend. It doesn't matter to her if we have this entire month off when it comes to data, because also everyone thinks the Fed maybe is a little bit too obsessed with month-to-month data. She's looking at the trends, and the trends are showing you that we potentially are going to have a higher unemployment rate, and there is some weakening in this economy. It's just so difficult when you wake up and you're talking about trillion-dollar companies and the capex boom we're seeing when it comes to artificial intelligence in the top companies on the S&P 500.
Delivering fantastic profits. That divergence between corporate earnings, great, and the labor market, not so great. The Fed's responding to one and not the other, and the market is focused on both. We get the rate cuts and the earnings. Stocks are at all-time highs. In the bond market, two-year bond yields at the front end of the curve around 350 now. Repricing lower this week, down by around 10 basis points off the back of weaker than expected economic data, 353.88. Under surveillance this morning, divisions remaining at the Federal Reserve.
If we don't get the official unemployment rate, we're going to go off of what the data we have. If we released it today, it suggests that the unemployment rate was unchanged for this month from last month. I think it indicates some steadiness in the labor market, and I think the underlying economy is still growing pretty solidly.
So here's the latest this morning. The Chicago Fed President Austin Goolsbee leaning on alternative data, saying the labor market remains stable. Mike Collins of PGIM calling his macro base case a muddle through, writing, while downside tails remain and there is a chance of a mild recession, we see limited crash risk. Mike joins us now for more. Mike, welcome to the program, sir. It's an odd one, isn't it? No payrolls report in 42 minutes expected. But let's go with the language from Austin Goolsbee. He seems to think the labor market is solid. Would you call it solid? Would you say things are stable?
Yeah, the labor market is a conundrum, Jonathan, just like a lot of the economic data and like the Fed outlook. And what you're seeing in the labor market is the supply of labor is coming down fast, right? Plans for companies to hire is kind of in a free fall, right? But the one outlier within the data is the firing, right? We're really not seeing any layoffs. It's just kind of a flat as a pancake in terms of companies laying people off, firings. So maybe companies are really just holding on to the people they have, trying to maintain their margins through other means, right? But I think you are seeing this kind of sneaky weakness in the job market. I would say if you look at the whole, data set of the labor market, it definitely looks like it's weakening to us. Typically, the last thing to happen, right, is companies lay off people. So maybe that's the last shoe to drop.
Yeah, Mike, that's what I want to get into here. You've seen it all for a long time. You've been one of my favorites in fixed income. You know that. I can say it loud and proud right here on TV. Mike, it's very strange to see such a strong corporate earnings profile at the same time we see such muted hiring intentions. When you start to see that, does it typically break one way or the other?
Yeah, one chart I was looking at yesterday, Jonathan, if you look at the stock market, right, it's going straight up. And then you look at the growth rate of the labor market, new jobs, it's going straight down. Typically, those things are highly correlated, right? So something's got to give. And I would guess it's the ebullient, real bullish fever we have out there in asset prices and in markets and maybe even in earnings, right? Earnings expectations, as you know, Jonathan, for the next 2 years are still in the low teens year over year growth. Now, granted, a lot of that is concentrated in a relatively small amount of companies, but you are seeing earnings breadth in the stock market really expand a little bit here, which is very encouraging. Why you're seeing things like the Russell 2000 small companies actually start to outperform a little bit here, or at least catch up, which is nice. So it is a real challenging environment for an economist, for an analyst, for a data scientist, for the Fed. To parse all this data and figure out, you talked about in your opening, the muddle through is our base case, meaning growth is going to be in the ones, inflation is going to be in the high twos, right? The labor market is weakening, but isn't going to fall apart. That's like the base case. But wow, the tails, Jonathan, are pretty big. And the downside tail is recession, obviously. And it seems to me like that risk is actually increasing, albeit it would be a mild one. But the upside tail risk, where earnings continue to boom, the stock market continues to boom, AI CapEx continues to boom, the wealth effect continues to drive the economy. that's a big risk, right? And the problem is, so that's the bubble scenario, right? You have the recession scenario and the bubble scenario as your tails, and they both end badly, right? So that's really where you're trying to thread the needle here in the bond market, and when you're managing money to try to really rely on that base case and not blow up in the tails.
Mike, putting these two stories together, how does the Federal Reserve address higher unemployment because AI is taking those jobs and AI is doing so well because the CapEx you're seeing at these companies?
Yeah, I mean, productivity, right? I mean, that is the upside story, Annmarie, right? It's the AI, it's the productivity boom, it's the resilience of this economy, which has been largely driven by this really powerful wealth effect, which does have legs. And there is a trickle down component, right? I mean, the stats you see are, 10% of the wealthiest people in this country are driving 50% of GDP. Unfortunately, the other 50% of GDP, as you've reported, is coming from AI CapEx, right? So you have this really kind of bifurcated, economy running on these two small, powerful engines. And I do worry about the breadth of the economy and the other 90% of the people who are really struggling. And you are seeing personal bankruptcies go up. You're seeing weakness among even corporations in some cases. You're seeing, distressed debt situations start to percolate more frequently. So typical late cycle signs are starting to emerge. And I think you have to really be cognizant of that.
You mentioned potential recession. Could we have a shutdown-induced recession?
I don't think so. I mean, when we looked at the last time we did this, Annmarie, it was 35 days, right? And we did the math on the actual impact to GDP. It was 1 basis point, right? So if GDP it was at 2, it went to 1.99, right?
But Mike, hold on. This time could be different if we get permanent layoffs at the U.S. government.
Yeah, I still think it's a little bit of a rounding error, and it's really the big private sector that we worry about in terms of the impact on GDP, and the private sector writ large is actually doing really well here. They're continuing to be creative and come up with new ways to generate earnings, generate sales, maintain margins, which has been one of the biggest shocks. You look at profit margins, right? I mean, I've been saying for years now that they're going to come down, and they really haven't. Maybe the layoffs are the next, like I said, shoe to drop to preserve margins. But, the private sector has done really great here.
So, Mike, does all of that justify where spreads are right now?
Yeah, credit spreads, I know, Jonathan. Everybody talks about how tight they are, and I know this is a little inside baseball, right? If you look at corporate yields, they're up here. Treasury yields are here. Swap yields, like interest rate swaps, are way down here, right? So part of me thinks, you're looking at credit spreads relative to treasuries, might be a little bit of a mismeasurement issue, right? Treasuries are kind of the things that are cheap, right? They've sold off relative to other fixed income assets, including interest rate swaps, which is a risk-free asset, and corporate debt, which is increasingly pretty safe, right? Fundamentals in corporate credit, high yield credit, the big publicly traded credit markets are really, really good, right? So maybe it's justified. And maybe it's the treasury yield that's cheap because of all the supply, all the concerns about the fiscal, and all these auctions that we have to, find a level to clear the markets with.
True. Mike, it's a smart way of thinking about things. Thank you, sir. Important final point. Mike Collins there of PGIM Fixed Income. No jobs guest today because we're not expecting a jobs report in about 34 minutes' time. And typically I'd just sit here. First question, what's your job guess?
I know.
8:30 Eastern time. What's your job guess?
I mean, I guess you could still guess. We're not going to know whether or not it's right or wrong for who knows what. TBD.
You put it really well, Annmarie. The jobs report has been less dependable anyway so far this year.
It's been cancelled already.
Maybe taking a break isn't such a bad thing. Up next, the third hour of Bloomberg Surveillance.
This is an unfamiliar political situation in just so many respects.
It's very difficult to look at the data without having the data.
The less data that come out, the less of a reason the Fed would have to deviate from the dot plot.
Earnings season is going to take on even more importance if we have a lack of government data.
Companies are going to operate through fog.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We should do this more often, just Fridays. First Friday of the month without the payrolls report.
Should we just go home?
Just way more chill, isn't it? Going into the weekend. From New York City this morning, good morning to you all. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your equity market at all-time highs on a 5-day winning streak, adding some weight to the rally. Equity futures this morning positive across the board, up by 1/10% on the S&P. On the Nasdaq 100, up by 1/10%. Also, some outperformance, just a little bit. Over on the Russell, the small caps up by 0.4%. In the bond market, focused on the 2-year, we have had a repricing lower on the week so far off the back of the data we have had, which has been weaker than expected. 354.29 on 2s at the moment. As for the week ahead, the day ahead going into the weekend, you do get some data. Probably not getting payrolls at 8:30 unless something spectacular happens. ISM services, though, want to watch at 10 a.m. Eastern Time.
So we do get something in this data desert, as Jordan Rochester called it, but we're not getting the big one, the one that the Fed really cares about. But I love what Francis said the last hour. She's actually happy about this because the Fed is almost too tethered to every single month's data dependency. And Trump already months ago threw cold water on the data, saying you can't really take it at what face value because of the massive revisions. People in the market were like, yeah, we've been saying this for a while. We don't love the data collection. The revisions haven't been great. We still want the data, but it would be better if it was more prime time, if it was more accurate. So the jobs report has already been canceled. Now it's basically officially canceled. And the question everyone is when are we going to get it? When the government opens? We're day 3 of the shutdown. Likely it's going to go through the weekend. We're here for at least another few days.
The CPI, arguably the bigger one in a few weeks' time. Is that going to be delayed? Does this shutdown basically delay the next payrolls report as well because of data collection issues? Let's just run with what we've had so far this week. Hasn't been great. Factory activity shrinking for a 7th month. No new information there. That's been a shaky story for a while. Consumer confidence 5-month low. ADP weakest since 2023. You put that all together. If you wanted a picture of the economy right now based on the data we have had, it hasn't been tremendous.
And this is what a lot of economists have been arguing, like Francis. The trend is already set. You don't need today's jobs report, which we're not going to get, it's MIA, to basically tell the Fed that they should be looking at what's happening in a weakening labor market and cutting again. We know that's where the Fed's bias is right now. The issue a lot of people are starting to have, though, is that by mid of next year, some economists think the tariffs will actually start to bite. Is that going to mean more potentially inflation, or is that going to be mass layoffs because corporations can't just eat the tariffs anymore and they actually need to start making up some of this on the margins?
27 minutes away from staring into space, waiting to see if something crazy happens. Mike McKee's going to join us.
Look at Truth Social.
Later on this morning at 8:30 Eastern Time. Maybe the president's got the number. Perhaps he'll release it. No one really knows. Equity futures on the S&P 500 up by about 1/10%. Coming up this hour, Nadia Lovell of UBS as stocks trade near all-time highs. Becky Frankiewicz of Manpower Group as we break down the health of the labour market. And Seth Carpenter of Morgan Stanley warning that tariff impacts are still ahead. We begin this hour with stocks shaking off the political division in Washington. Nadia Lovell of UBS writing, we expect the market to stay steady despite the government shutdown, with temporary macro data delays unlikely to stop further Fed rate cuts. Nadia joins us now for more. Nadia, good morning.
Good morning.
Is this delay to the data, not the suspension of it, but the delay of releasing it, is it a reason not to take risk in any way, shape or form?
Absolutely not. You're seeing it today in the market. I mean, the economists might have less to do today, but the equity market still has a lot to do and investors still have a lot to do. When you think about it, it feels like the chase is on, Jonathan, right? The sort of the seasonal weakness that some were looking for in September didn't materialize. And that's because the corporate commentary has been pretty sanguine, right? You also have the AI story that's still very much alive. So we think that the ingredients are coming together for a meltup into year end. And so there's a lot to do in the equity market, despite the fact that our government is shut down and we hope it reopens soon to be able to pay its employees.
It sounds like it doesn't make a difference to you. So let's go with that phrase meltup. What does that phrase mean to you? Just help define that just a little bit. If the chase is on, what's a meltup look like?
Well, when you think about it, you have a market that's up a lot since the April lows, up 14% year to date. But reality is not everyone has participated in that. And so there's some performance that needs to be made up by the time we get to year end. And reality is we do know that from a seasonal standpoint, fourth quarter tends to be a pretty solid quarter, especially when you've had a solid year to date. And then when you look into the Q3 earnings season, I think that is going to be a good one. You know, consensus right now is looking for about 7% EPS growth. We could get to high single digits to low double digits. And the fact is the spending continues
in AI. So you could see this market that continues to move higher, another 3, 4, 5% into year end. Now, that's not to say, even if you get a small pullback, it's going to be bought, in our view.
Who hasn't participated that you're looking to participate?
Some of the long onlys haven't participated. A lot of this has been driven by corporate buyback. It has been driven by the retail investors, also some of the systematic. But you do have some long onlys that have been sitting on the sideline. You know, the drawdown in April was sharp, fast, and the rebound has been also fast. And some have missed out on that.
What are you looking for in 2026? Because you're thinking a melt up going in. Does it at some point there's a catalyst for it to bust?
Look, don't think that there's a bust coming. You know, yes, there's chatter about, you know, potentially being in an AI bubble. And the fact that we're debating it suggests to me that we're probably at, if we are in one, which we don't think that we are, that we're probably at the start of one, much closer to the start of one than towards the end of one. And when you think about it, the AI cap stories continue to pick up. We think that you could see $500 billion or so global AI spending next year. Now, there's this question about monetization, but even that is starting to show some signs of pickup. We're seeing improvement. I mean, look at the slew of deals that have been announced in partnership in the last couple of weeks, and even like the amount of product launches that you've had from someone that's in the center of this, OpenAI, this week. And so it does suggest that you could start to see us move into that monetization phase in a more meaningful way in 2026. And then reality is, ahead of midterms, I think this administration will be focused on growth.
You've just said something important about people not participating, and I just want to sit on that for a beat longer. Why they haven't participated. 6 months since April 2nd, and a lot of people were scared out of this market. Then people started to chase it. To the extent that people didn't participate, this is what Torsten Slok's got to say on the issue right now regarding the pandemic, regarding Liberation Day, rather, which felt like the pandemic at the time. The US economy remains remarkably resilient, and it's becoming increasingly difficult to argue that we're still waiting for the delayed negative effects of what happened 6 months ago. How many people do you speak to are still being held back, waiting in fear about seeing the consequences of what happened 6 months ago?
I think it's sort of to continue to what Anne-Marie's question was, does it come in 2026? I think people are now saying, does this come in 2026? But there's some level of capitulation that's starting to happen now, because you're just not seeing, you're not hearing it from the companies. And we know that the government data, we're not sure if we can trust it, right? So you now have to listen even more to the corporate side, which is what we've always been saying. And when you look at the conference season, in September, corporates were, saying that things are okay. You're not seeing huge pressures on the consumer, nothing incremental. The lower end consumer, we've known for a long time, has been weak. But the middle to upper income consumer, still has a lot of cash and this wealth effect, right? That they can be able to sustain some of the price increases that we do think will come in a more gradual way. But we don't think that that's going to be any sort of meaningful pullback from those kind of consumers.
As they capitulate, where are they going? Is this all concentrated in tech, or are you starting to see moves elsewhere?
You are seeing a broader now. I do think that from an investment standpoint, it continues to flow into tech, but you're seeing small cap also pick up. And also, we think that a sector that might be interesting for a catch up here is healthcare, especially after this week. You're getting a lot more clarity on the policy front standpoint with this deal between the administration and Pfizer. Does it serve as a blueprint for more deals? The fact is that most favored nation, right? There was concerns that could be a broad-based policy. Now it looks like it's mostly concentrated in Medicaid. So that could be a positive for the overall healthcare industry. And the fact is that, valuations are quite suppressed. We've talked about elevated valuation. Healthcare, 25% discount valuation to the S&P.
Nadia, do you take a look at lists like pharmaceuticals, companies that are important for U.S. national security and defense, and start thinking about maybe people should get long on these because the U.S. government might take an outright stake in these companies?
We'll see if that extends to healthcare. So far, it hasn't. But we think about things from a structural growth standpoint, and that's why we do think that healthcare and the national security sort of played in that. Healthcare is also part of that story. Eventually you are going to see from a longevity standpoint, at the end of the day, we have a population that's getting older. We have innovation that could come even in healthcare through AI in terms of drugs discovery. And so we think that there's a structural story happening in healthcare as well. Along with, of course, our most preferred way to pay structural growth is through tech, but we think that healthcare is part of that story too.
When you look at this melt up, some economists are saying, but we can have a higher unemployment rate. Jobs market is weakening. How do you have both? Isn't it so uncomfortable?
we always say, the stock market and the economy are two different things, right? Like, yes, you could have an increase in the unemployment rate. We're not looking at any sort of meaningful increase.
But this administration, basically, their barometer of how well they're doing with the economy is looking at the stock market. Is that a challenge?
Well, if they're looking at the stock market, then they think they're doing great, right? But in all seriousness, from an employment standpoint, we don't think that you're going to see any sort of meaningful pickup in unemployment. And at the end of the day, we know that the Fed is there, right, to help backstop some of that and to help to stimulate the economy. And if we can unlock the housing market, maybe there's a national emergency, I'm hearing, in terms of the housing market. That can also help in terms of, wealth creation and also to help that cyclical part of the markets and the economy.
Who needs a jobs report? It's good to see you, as always, on a Payrolls Friday without the payrolls. Nadia Lovell of UBS. Let's give you an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Well, we are in the third day of a government shutdown. The Senate is expected to hold another vote today on a stopgap spending bill to reopen the government into mid-November. Democrats are holding firm on demands to extend healthcare subsidies. President Trump is threatening to slash jobs at what he calls Democrat agencies that don't align with his agenda. The Trump administration has frozen $2.1 billion in Chicago infrastructure projects. U.S. Budget Chief Russ Vought sharing on X that, quote, the Red Line extension and the Red and Purple modernization project have specifically been put on hold to, quote, ensure funding is not flowing via race-based contracting. The Trump administration has also frozen $18 billion in New York infrastructure funding for, it says, similar reasons. BlackRock's Global Infrastructure Partners is said to be in advanced talks to acquire Aligned data centers. Aligned could be valued at about $40 billion. The deal would be one of the biggest of the year. A spokesperson for BlackRock declined to comment. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, the Morning Calls Plus, Becky Frankowitz of Manpower Group, as we break down the health of the labour market. That conversation up next, live from New York City this morning. Good morning.
This shutdown is compounding an existing problem, which is that our data is being substantially distorted by tariff developments, front-loading, inventories. On top of that, now we're going to miss probably a month of solid evidence as to what actually happened in there. To us, this is going to raise more questions than it is make it very clear what the definitive path ahead should be.
That was the brilliant Francis Donald of RBC weighing in on what's happening with the jobs market and the broader economy. Going into 8:30 Eastern time without a payrolls report. That number supposed to drop 15 minutes from now, but of course not going to drop, not expected to drop because of the government shutdown. Entering day 3 in the equity market. Equity futures positive by 0.1% following 5 days of gains. On the Nasdaq 100 up by 0.14. On the Russell up by 0.45. In the bond market, lots of weak economic data this week, bringing down the 2-year bond yield to the low 350s, 354 right now, just about unchanged on the session. Lower on the week by around 10 basis points. Talked lots about weak data, ADP, the quits rate, manufacturing, the ISM, all of that. But let's talk about strong markets. All-time highs in the equity market. Multi-decade tights for investment-grade credit spreads. And we just came off the back of the biggest month of credit issuance for the month of September, at least, for corporate debt supply, high yield and investment grade. It's been quite a few months for financial markets, even though we've seen this deterioration start to creep in to the labour market. So that's the price action and the broader economy. Let's get you some single names and some morning calls. First up, UPS, lowering its price target on UPS to 110, saying it's likely on track with prior expectations of a low double-digit decline in domestic volumes. Your second call from Wells Fargo, lowering its price target on Uber to 125, seeing delivery volumes in its Q3 report as key for lowering investor concerns. And finally, Jefferies cutting Apple to underperform, seeing an overly bullish iPhone outlook. A stock is down by 0.8%. Let's turn back to the labour market. The government shutdown halting the release of the payroll data. Becky Frankowitz of Manpower Group, one of the world's leading staffing companies, writes the following. The official jobs report might be on pause, but the labour market keeps moving. And our data shows a market in transition. Becky joins us now for more. Becky, welcome to the show. It's been too long. What are we transitioning from and to what?
Yeah, so first, it's a strange no jobs report, Jobs Friday. So usually we say Happy Jobs Friday, and it is still a Happy Jobs Friday because we see real-time, real-world data. And John, we're watching three trends. First, job hugging is the new job switching. So we're not seeing workers switch jobs anymore. We're seeing them hold on to their jobs. In fact, switching is down 50% in the last 2 years. So workers are staying put. The second big trend that we're seeing is lateral is the new vertical. Employers are holding on to their talent. And so there's this change called micro mobility, where we're seeing people change titles, but not change companies. And the final piece I'd say is growth isn't gone, it's just moved. So we're seeing growth in immediate benefit roles, a lot of growth in the data scientist, database architects, things that are tech forward. And we're seeing some shifts in even manufacturing, where we're seeing blue collar workers like engineers, people who are on the front line in terms of manufacturing starting to grow. Logistics is a little bit soft. Of course, education, retail is showing some strength, but there is still growth. You just have to look harder to find it.
Becky, is there growth in entry-level jobs?
Annmarie, it's one of the top things we're watching. So if you said, what are you watching closely? I would tell you impact of AI and entry-level jobs. We are seeing reduced demand for the educated, yet inexperienced. And that is people coming out of college. So employers are prioritizing people who have actual experience because, again, they want immediate impact. Employers aren't hiring to develop people. They're hiring to actually get benefit from their hires today. And that is impacting our entry-level professionals.
Historically, what kind of time can you reckon this back to? When did we see such a weak environment for entry-level jobs?
Yeah, it's been a long time, Annmarie. We're not in the 2008 stage yet, which was a huge crisis, but we are seeing a drop of about 6% in terms of the demand for entry-level jobs. And it's coming at the same time. The overall job market is continuing to cool. It's not just cooled, it's continuing to cool. We see total jobs posted. Again, I don't need BLS to tell you this. We look every day. Total jobs posted have dropped under 7 million. It's always been a 7 million mark, under 7 million to the lowest level in 4 years. And we're seeing this overall slowing in jobs, and we're seeing a change in the kinds of jobs people are hiring entry level. And in part, it's a bit of wait and see on AI. I heard one of your prior guests talk about that. It's a bit of wait and see, but it's also a bit of economic uncertainty causing me to prioritize today versus tomorrow.
Becky, can we just pick up on the AI point? Where are you seeing that? How's it showing up? And how do you draw a distinction between what is driven by AI and what's driven by traditional, broader economic concerns?
Yeah, well, it's hard to break apart, John, if I'm honest, but I'll tell you what the data is showing us. And the data is showing us that tech forward roles are surging. Again, database scientists, data architects, anything on security is surging today. Of course, we've seen some softening in software developers, but guess what? Back to entry-level roles, it's still one of the top 3 entry-level roles. It's down almost 50% year over year, but it's still in volume one of the top 3. So we're seeing a pretty balanced view on AI right now. Employers are still telling us that if they're more tech forward as an employer, digitizing faster, they're intending to hire more. We're waiting to see that play out. But right now, I would say we're seeing a balanced view on AI. But there is a lot of wait and see on the promise of the impact of what AI can give our economy.
So, Becky, are you seeing any supply side issues? Because the big debate on Wall Street is, yes, we've seen a step down in payrolls growth, but we've also seen a step down in supply. And the economists will come on the program, and some of them disagree with each other. Some might say, this is bad, we need to respond to it. Others might say, well, this is a supply side story. Yes, you've had a step down in payrolls, but you've not had an increase in labour market slack. From your standpoint, is there a supply side issue? Do you see that showing up in the business?
Yeah, we're not seeing significant supply side issues, John. What I would say we're seeing is a bit of, and I'm not using it economically, a bit of stagnation in terms of mobility. People are staying put. And when people stay put, it is harder to free up some of the supply to actually generate this transition that normally underpins our economy. When I tell you that job switching's down 50%, 50 in the last 2 years, that is significant. And that's not having an impact on overall supply, but it is having an impact on mobility. And mobility generally leads to growth in our economy.
Does this mean workers are not asking for higher wages?
Yeah, great question, Annmarie. What we're seeing now, again, during the heights of the pandemic, we saw huge bonuses for switching jobs. We're seeing that level has dropped below 7%. So the premium on switching a job in terms of your pay increase traditionally runs around 7%. We've seen that now drop to about 6.75%. So we're not incenting people to move, and we're seeing an increase in people who stay put. So I'm telling you, this whole idea of job hugging is real from the employee view. And this idea of lateral, not vertical, giving titles and a little bit of pay is real from an employee point of view. So they're coming together in a way that people aren't moving.
Workers that are able, though, to move structurally higher in an organization because they moved an organization, what sectors is that happening in?
Yeah, so Annmarie, we're seeing only 2 sectors. We're seeing this increase in switching, if you will. That is construction, and that is in the financial markets. And you've seen the headlines on the financial analysts that are switching all over New York City. So those 2 roles still have quite a bit of agency, and we are seeing switching there. But for the others, we're really seeing people stay put.
So, Becky, we've been in this low churn dynamic in the labour market for a while now. Economists have been talking about it on this programme. You have too. When things break one way or the other, we're always looking for that early indication. Now, correct me if I'm wrong. I think you used to lead Quaker Foods. When you oversaw that business, Becky, what kind of behavioural changes were you always looking out for a leading indicator of which way this economy was about to break?
Yeah, so John, you're taking me in the Wayback Machine now. We would look at number of items in the basket. And so how many goods are people buying, trips to store, average purchase price that you're actually putting in your basket. And I know now from the jobs market report, or what we see in terms of people actually hiring, who's hiring today? It is the cost-conscious consumer companies that are hiring. Domino's is hiring. Lowe's is hiring. So we're not seeing the high-end retailers hiring. We're seeing the more accessible retailers hiring, which tells me, in terms of early indicator, people are still very cost-conscious, uncertain about what's coming, and holding on to their dollars like they're holding on to their jobs.
Becky, this was great. Let's do it again soon. It's good to see you. Who needs the jobs report when you've got Becky Frankowitz of Manpack Group to go through what's happening in this labour market?
Totally agree. And what she's talking about is what we've heard from a lot of people. I just love the term she used in terms of job hugging. That's basically what Neela has been talking about for months at ADP. This idea is it's paralysis in the labor market, low hiring, low firing, and people just want to stay currently in place.
Saw it in the quits rate as well in the job openings report earlier this week. And these things can feed on themselves, that negativity. If you start to feel like that about your job, it can influence the consumer behaviour. The good news so far is we haven't seen a decline in retail sales. In fact, coming out of the summer, retail sales actually picked up. So again, we're in the same point. Which way is this going to break? It's a huge debate about that right now.
Individuals are still going out. They're still going out and spending. I think what's so concerning about the labor market, and Governor Waller has talked about this, is individuals who are graduating college, entering the job market. When I entered the job market and I graduated college, the unemployment rate was 9.2%. And that is a scary place to be. On top of that, what individuals now are dealing with is this concern that maybe AI is just going to take their job.
It's not where we want to be, that's for sure. Futures are positive by 0.1%. This market keeps grinding higher. Equities at all-time highs. Up next, Seth Carpenter of Morgan Stanley. Live from New York City, 25 seconds away from the payrolls report. Just so used to, just want to get there, and it's not happening. It's not happening. Your scores look like this. Equity futures positive by 0.1% on the S&P, and the Nasdaq up by 0.1. The opening bell about 60 minutes from now. You're still kind of on jobs report watch, aren't you?
Yeah, I keep refreshing
Just
Donald Trump's Truth Social.
I can tell you the estimate's 53k. The previous number was 22, but we're not expecting one because of the government shutdown. We'll see if we actually get one, but not expecting one. As we count you down to the opening bell in about 60 minutes' time, let's get you some single names, some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. This is where the excitement is, maybe. Apple shares declining this morning. A downgrade from Jefferies to underweight. They had it on hold before, saying that there was excessive optimism about the refresh cycle for the new iPhones, that essentially they kept prices as is, which is maybe why they're generating some excitement about it, but also that there would be lower prices in effect for the base 17 model. And all of that is already in the price. but just too much enthusiasm, they say, in the valuation. So shares down 0.8%. Elsewhere, Applied Materials continues to fall this morning. They issued yesterday a filing saying that the Trump administration has, specifically the Commerce Department, has expanded their restrictions on exports to China. They, of course, make the machines that make chip makers. So those shares down 2.3%, just under that, as they expect a $600 million hit to their fiscal 2024. Finally, rounding things out this morning with USA Rare Earths, a CNBC report that they've been in conversations with the Trump administration about a potential deal. So those shares surged 12.8% after a string of other deals with rare earth mineral producers and the Trump administration. John.
Danny, thank you. Appreciate it. Thanks for this morning. More from Danny in about 30 minutes' time, alongside Matt Miller for Bloomberg Open Interest, counting you down to the opening bell about 59 minutes from now. No payroll data so far today. Not expecting any because of the government shutdown. Joining us now to discuss is Bloomberg's Mike McKee. Mike, it's an odd one, isn't it? We haven't done this for a while. I think the last time was 2013, was it, to have a delay like this?
Yeah, because we got the numbers in 2019 when they were shut down. It's kind of weird because Jobs Day and you go to Danny first.
It's not personal.
John, well, we have disappointing news for you in terms of the jobs report. No jobs created or lost because we don't have any data. As you mentioned, the government shutdown. If we had data, it's hard to know exactly what it would have been because the alternative data sources that we look at have very different views. The Bloomberg consensus was for 53,000 jobs. Revelio suggested we'd get 60,000. ADP suggested we'd lose 32,000. So who knows? The Chicago Fed unemployment proxy, 4.3%, would have suggested no change. So if the Fed goes with that, they'll probably be okay. And I want to point out that all this comes from WSLALTE Go on the Bloomberg. That is where you can find a huge long list of alternative data, and everybody's looking at that these days. We do have to worry about going forward where we go from here because everybody has to have something to trade on. The shutdown delays the CPI report on October 15th, maybe. That would not be good for the Fed or for futures trading. And if we go too long into October, the jobs and CPI data collection could be imperiled because we won't be able to collect that data if there is nobody to collect it. We could also see unpaid contractors under the shutdown start widespread layoffs. And of course, we have this threat of Trump firing thousands more federal workers. So the labor market, you could safely say, I think, is in turmoil at this point. Danny said Apple is where the excitement is today, and so go with that because we haven't got it in the labor market at the moment.
Mike, do you think that NEC was given the labor market report, though, yesterday, as they normally are?
No, they wouldn't be under the circumstances because nobody is at the Labor Department or the BLS to give the report to the commissioner. The commissioner gets it on Wednesday, and the government was shut down then, so it would not have been transmitted over to the White House.
Mike, looking forward to your conversation at about an hour from now. I think it's at 9:30 on Bloomberg TV with Governor Myron, the man of the moment on the FOMC. Mike, what have you got in mind for this conversation? And what have we learned so far about how the Fed's going to guide itself towards this big meeting at the end of this month if we don't have this data?
Well, what they're going to have to do is go with their best guess and go with what they think they have learned from talking to CEOs and companies around the country in terms of where we're going. The general feeling in the markets is because there is no data, they don't have a reason to change their view that they were going to cut rates in October. As for Stephen Myron, we'll have to ask if any of this changes his view, especially the idea of a very low neutral rate if the government can't show us what any of the inputs to those models are.
Mike McKee, thank you, sir. Looking forward to the conversation, 9:30 Eastern Time. Michael McKee, alongside the man of the moment on the FOMC, Governor Stephen Myron. Joining us now to discuss, Seth Carpenter of Morgan Stanley. Seth, this is so peculiar to have this conversation on a day without data. Can you describe what your conversations have been like with clients this week?
Yeah, a little bit all over the place, but actually drawing off of what Michael just said, that there are, other data sources people could look at, and he characterized the numbers as being all over the place. I agree with him from a negative number for ADP to the positive numbers either for the consensus or the alternate measure he showed. I think, though, if you take all of the numbers that were up on the screen just a couple of minutes ago, none of them is especially strong. And so I think the key thing we do know is that the labor market has slowed down a lot this year. there's no sense in which it's quite strong. And so right now, I think the real key tension, intellectual tension with any of the data that we have and that we know about is that spending data has been holding up. Labor market data has been quite soft, whether it's negative as in the ADP or very slightly positive by the other measures. I think the real tension is how is it going to resolve itself, this very, very soft labor market against persistently resilient spending data. Historically, I would say labor income tends to be a fundamental driver of aggregate spending. And so in our forecast, this tension gets resolved with spending coming down. But that's going to be a really key question for markets, I think, over the next couple months.
Seth, even trying to predict the future, can we talk about how this has happened? Clearly, the economy is not as strong as it was. On the labour market side, people are anxious about their jobs. So we can see that in the data. Consumer confidence is low. They don't think jobs are plentiful. You saw that from the conference board earlier this week. The quits rate has dropped. That speaks to a little bit of anxiety as well about the labour market. But retail sales coming out of the summer, bang, pop. Seth, what explains that?
I think we've just seen lots of swings back and forth in what's going on in the economy, people's confidence in the economy. We know, for example, that immigration restriction has had a meaningful effect, and that's reducing both the supply of labor, but immigrants are also a source of demand in the economy. And so the net effect, is it more supply or demand that dominates? That's a question for the price outcome. Is it going to be inflationary or not? How inflationary will it be? But in terms of quantities, in terms of economic activity, it's unambiguous. That's got to be negative for overall economic activity. So I think that's part of the slowdown. For spending, though, we have to remember the top end of the income distribution does a disproportionate amount of the overall spending in the economy. And we know that the top end of the income distribution is actually doing quite well. Wealth effects are higher, among other things. And so I think there's definitely some momentum going on there with the consumer, especially at the top end. What remains to be seen is how sustained that can be when we get more and more time in with these tariffs. Remember back in 2018, it took about 2 quarters to 3 quarters before we saw the real drag on the economy from the tariffs. So I think we're still in the early innings with the drag on the economy from the tariffs.
Seth, is it momentum because they have this money to spend, or is it angst because they're worried about prices going up because of the tariffs? And I say this coming from a family that was doing Christmas shopping in May.
Great question. And if I go back through the database of periods of really high inflation over the past 35 years. Oh, wait, we don't have a lot of experience with this. I think it could be some of everything. And there's no reason for us to choose one versus the other. When there is this disconnect, though, between current spending and the trajectory of the labor market, I think the evidence suggests we should expect the labor income reduction to eventually win. And so that's why we're thinking the strength in spending is temporary, not going to be sustained for the rest of this year and into next year. But it's a real puzzle.
If you don't think it's going to be able to be sustained for the rest of this year, what kind of Christmas sales are we going to be looking at in holiday spending? Are people just going to hit a little bit of pause?
I think that's a real possibility, and we are looking for Q4 of this year and Q1 of next year to be the real slow points in terms of quarter-on-quarter growth. But Christmas, it brings back the same sort of questions that you brought up. Did people front load Christmas shopping, in which case you'd expect weaker spending? Or is it possible instead that with people feeling anxiety, they try to make themselves feel better by having a better Christmas? This is one area where, as macroeconomists, we have much less visibility. And we at Morgan Stanley try to connect with our colleagues in the single name equity research space to try to get a better read from the bottoms up from the actual retailers themselves. So this is going to be a question I guarantee you over the next month or two is going to be absolutely critical for us.
Seth, just before you go, I don't know if you saw the note that came from Torsten Slok of Apollo earlier this week, where he said the economics profession needs to take a long, hard look at itself in the mirror, that this economy has been much more resilient than people thought, and betting against it ultimately has been a fool's errand. He says later on in the note, he talks about waiting for something that happened 6 months ago to see the consequences of it. Do we need to question that a little bit more, Seth? That's what he was alluding to. How are you thinking about this process that you and I have discussed now for 6 months? Are we just waiting for the consequences of something that happened a long time ago and we'll just be sitting here waiting and waiting? Or are we actually going to start to see real signs of it in the months to come?
No, it's a great question, and Torsten always is very thought-provoking. I've actually known Torsten now, I realize, for 30 years. I looked in the mirror really hard, and I wanted to look more like Jonathan Ferro, and so here we are. It's a great question. I'm an egg-headed, academically trained economist. I try to look at things through statistical models in addition to lots of other ways. There's the famous saying about monetary policy working with long and variable lags. I think all the estimates there is it takes 2 or 3 quarters before a monetary policy shock hits the economy and 2 or 3 quarters after that before it hits inflation. We are used to, as a profession, thinking about these long lags. We don't have anywhere near as much experience with tariffs. And so that's why we try to go back to the evidence we have from 2018, 2019. And the evidence there was it did take a couple of quarters. And then the effects were very long-lived. Manufacturing, industrial production data, manufacturing employment in the U.S. got hit when the tariffs were in place in 2018. We saw the fall late in 2018 there, and it continued to contract all of 2019. So it was a very, very, very long-lived process. That's our base case this time around. But could we be wrong? Absolutely. We are trying to use all the available information, but these are very difficult circumstances to forecast in.
Seth, it's good to see you. And just for the record, you wear it so much better than I do. Seth Carpenter of Morgan Stanley. Seth, thank you. Good to see you, buddy, as always. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. A senior Hamas official says the group will respond to President Donald Trump's plan to end the war in Gaza, quote, very soon. The official said Hamas rejects a take-it-or-leave-it approach to the proposal. He added the group will not accept the surrender of the rights of the Palestinian people after all their sacrifices. Bridgewater Associates' flagship macro fund surged 26% in the first 9 months of this year. Sources telling us here at Bloomberg that the hedge fund is on track for its biggest gain since 2010. Overall, hedge funds have seen strong gains this year, driven by surging U.S. share prices and volatility spurred by President Trump's tariffs. A Rolex worn almost a century ago by the first British woman to swim the English Channel will be up for sale. Mercedes Gletzke's Rolex Oyster is considered to be the world's first practical waterproof wristwatch. The watch could fetch over $1.3 million at Sotheby's auction in Geneva, November 9th. That is your Bloomberg Brief. John.
Vonnie, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. Plus, we'll touch base with Jeff Rosenberg of BlackRock from New York City. You're watching Bloomberg TV.
We've been in this low hire, low fire labor market. I wouldn't just say because historically it hasn't mattered. If it starts to actually, there are layoffs here, I think we have to start thinking that the labor market's much weaker. We're already a little fragile.
That was Priya Misra of JP Morgan. Just as equities turn flat and unchanged on the session so far, just about going nowhere. Likewise on the Nasdaq 100, the Russell 2000 just about positive by 0.2%. As we count you down to the opening bell, it's about 43 minutes away. Your trading diary into the weekend and a sneak peek of next week looks like this. At 9:45 Eastern Time, the PMIs. 15 minutes later, ISM services. That's the big data point really now going into the weekend. Plus then you've got a Senate vote at 1:30 Eastern Time. The government's still shut down, likely to be shut down going into the weekend and coming out the other end next week. Next week, we're looking for the following. I don't know what we will get and won't get, but the trade balance is due on Tuesday. Wednesday, Fed meeting minutes. Thursday, Delta earnings, plus we are due for another round of jobless claims. And on Friday, UMich consumer sentiment into the weekend, and sentiment has been soft.
Sentiment has been soft. I think the only thing really there that's most interesting to look forward to, if we're likely going to be in this shutdown, is the earnings. What is a company like Delta saying in terms of where they are with consumers? We know that the high-end consumers, the business class, they continue to spend. But also, are they seeing issues with the government shutdown? Is the FAA having issues in terms of whether or not these airlines are delayed and how that's working around the country? So I think that's going to be actually the most interesting data point.
Based on the economic data so far, not great. But based on what we've heard from the airlines, things are pretty tremendous, arguably because of what's happening with the upper income consumer. We heard from United, Delta. Anyone that Bramo speaks to in the airline space at the moment is basically telling her things are pretty good at the high end.
They're pretty good because of the high end. And the high end is basically lifting all boats when it comes to the airlines. The issue is the airlines that are catering to some of the lower end cohort not doing as well. But the Delta, the American Airlines, JetBlue, they're pretty doing.
Let's get you to the opening bell. Let's turn back to markets. So the S&P 500 is looking for a sixth consecutive day of gains. It's on a 5-day winning run, the longest streak going back to late July. Jeff Rosenberg of BlackRock has this to say: we believe the current market backdrop masks the high level of dispersion embedded within the economy today. Jeff joins us now for more. Jeff, welcome to the programme, sir. No payrolls. We're going to have to get knee-deep in all the other stuff. Jeff, I think that what you just said in that quote kind of builds on what we were discussing with regards to the airlines. How much dispersion are you seeing?
Yeah, this is really about the difference between what you're seeing on the top line and the headline and what's going on underneath. And we've talked about it a lot. When we do have payrolls or when we do have FOMC meetings, when Tom's with us, we talk a lot about the K-shaped recovery, about the differences between something you were just talking about, the top end and the bottom end. And you see that both for consumers, but also within businesses. You have the winners and you have the bottom end that is struggling. And that is the recipe for dispersion. And so when you take away kind of the big headline that we might have been talking about today, which is this is good for the economy, bad for the economy, a stock's going up, stock's going down, you go underneath the surface and there's a tremendous amount of churn going on underneath. And that, when you take away kind of beta investing and you focus on alpha investing, has created a tremendous amount of opportunity. And you see that in some of the returns that look at, say, factor returns, stripping out kind of directionality in the markets.
When you joined us in July, you were talking about a tricky environment ahead for the Fed. How tricky is it now that they might miss an entire month of data?
Yeah, so if we shift back to kind of the data problem, it's tricky for the Fed. It's tricky for us in investors. I was going to suggest that if we wanted to look at, and maybe your producers can do this quickly, the one area that might be benefiting from this lack of data is interest rate uncertainty. So maybe put up a chart of the MOVE index, which has collapsed here. But you look at kind of what we've been talking about this morning around the lack of data, and you have a lot of disagreement. The good news is you've got a lot of alternative data, but kind of the bad news is none of us can agree as to what that alternative data means. A good example is, I saw this morning 2 different estimates from alternative data, one using state filings, the other looking at extrapolating initial claims forecasts off of Challenger layoffs. They came up with completely different conclusions. Another example on the earlier segment, you were talking to Manpower, talking about switchers and the lack of switching, but you look at the Atlanta Fed wage data and switching wages actually went up a little bit. So in the cacophony, I think the benefit might accrue to uncertainty, although that doesn't make the Fed's job any easier.
Well, if you had to decide what your top 3 data points were, what would they be?
When we're talking about the payroll data and the lack of payroll data, I'll turn to the wage data and looking at inferences from that. We have the Atlanta Fed wage data. We have a lot of private sources in terms of what you can scrape. I'd like that alternative data. We've used that a lot in terms of both frequency and turning points. So that would be, kind of data point number one. I think, and Jonathan, you made reference to this earlier about the inflation data and whether we're going to start to lose some of that. I think the good news there is that with the web scrape data, we have a lot of kind of consistency around what people are looking at in terms of alternative forms of data. People talk about the price stats data. I think that's a good form. And then I think the pivot to the private data that you mentioned, where we hope we'll continue to get that. The survey data, the PMIs, they take on a heightened importance in this environment of the lack of the government data. We have to caveat that with the notion that the kind of accuracy that we've seen from the survey data, the PMI data, in terms of its importance for this kind of economy, that's really kind of gone down, and we've seen a decrease in the correlation between the PMI data and say the industrial production data in this cycle. So that's sort of a caveat to that third data point.
Jeff, we've talked about 5, 6, 7 minutes about economic data. If I'd given you the payrolls data at the start of the year for the next 9 months, I think you would have traded this market in completely the wrong way. So I just wondered, Jeff, what is the relevant data point right now? Because clearly some data is more important than others.
Yeah, that's absolutely it's absolutely the case, and it's the classical sort of break between kind of growth and inflation, and the pivot as to which one has the focus of the market. And going into before we had the shutdown, the other conversation would have been that this is the pivot away from the inflation concerns towards the growth concerns, and that the kind of top tier data point on payrolls is giving us that read on the growth, and the Fed's pivot towards a focus more on the growth and less on the inflation. And I think that's kind of the read here, in contrast to the beginning of the year where the focus was on inflation, the impact on tariffs and tariff pass-through. We really shifted that focus. And I think that's really the driver behind the directionality here in interest rates. Really the fear and the concerns to your earlier conversation with Seth Carpenter around, is there this lagged slowdown, the lagged effect? Remember, the tariff impact that Seth's talking about is not about the inflation piece, but it's on the real wage piece, that the temporary, even if it is temporary impact in terms of the inflation from tariffs, its impact is on real wage growth. And that's really about the growth side. And that's what's driving the rates markets right now.
Jeff, love catching up with you. It's just a bit odd without payrolls data, isn't it? It's kind of strange.
It is odd. Hopefully we'll get that back soon.
And when we get it back, we'll get you back, sir. Jeff Rosenberg there of BlackRock. Jeff mentioned the MOVE index, bond market volatility getting absolutely crushed. He's trying to produce the show now. The control room can respond. Here's the chart. This is what it looks like. It really has grinded lower as this year has progressed. That's been a steep, steep drop-off ever since the April 2nd Liberation Day story. I cannot believe it's been 6 months since then. I've said that a few times this week. That has been a blur. Think about the summer. July, August, September just zipped by.
Yeah, absolutely. This year has been like 10 decades in 1 year, and the year's not even over yet. And now we're dealing with a fresh amount of uncertainty in terms of, are we going to have a government that is operational, working? Will we be able to get to your flights on time? Will our men in service, women, get paid? These are a lot of questions going into the weekend. 1:30 is going to be interesting. Any Democrats, moderate Democrats, start to flip and vote with the Republicans to just keep the government open?
Has there been enough pay net generated to tip them over the edge, over the line?
Not yet, but I think next week there will be. You have to watch the senators in Virginia and Maryland. This is where the furloughs are coming from. All 8 of them, 4 of them are Democrats, so they have an opportunity there to push this over the edge.
When's the next game?
Saturday.
Saturday.
Blue Jays. Let's go.
All right.
Cheers.
Long weekend for you then, right? We'll see you Tuesday.
Exactly.
Okay, good for you. All right, coming up on Monday, we'll be here. Andrew Sheets of Morgan Stanley will be too. Paul Donovan of UBS, Amanda Lynham of BlackRock, Lindsay Piazza of Stifel. From New York City, thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.